Okay, good morning, everyone. Welcome to Byju's Exam Prep IAS. This is Sham Kagudio. Now, before we start the discussion, if there is no issue with the sound, can you please give me a thumbs up? Done. Let's start. Let's start. So, last week, what we have done, that's on Friday, we have started with a new chapter, that is the concept of taxation. Now, before I go forward, please do let me know how many of you have been able to, how many of you did get the time to read the articles that I've given in the last week. I'd given you a small assignment. I gave you around 12 to 13 articles and I asked them to read those articles. Now, please tell me if you have read those articles. Those who are yet to read, my recommendation is please read all of them. Right? Please read all of them. Again, logic is simple. All the articles that I've given are very much relevant to UPC examination. Very much relevant. Now, please tell me, were you able to, right, at least get a glimpse of what is being discussed in the current affairs regarding what we are discussing in the classroom? For example, we have discussed inflation. Were you able to understand what is actually happening on at the ground level? What is government of India doing? Whether these articles are, I'm sorry, whether these whether these measures are useful or not, what is the counterproductivity of these measures, what kind of measures should be taken by the government in order to control inflation, etc., etc. So that we will take it as a common exercise. Every week I'll keep on giving you I'll keep on giving you the list of the articles, right, in the range of around 15 articles, so that you will come to know, okay, what is happening in current affairs regarding these concepts. Now, we started with a new chapter, taxation. In taxation, what we have done so far, what do you mean by a tax? What is the definition of a tax? Tax is nothing but a compulsory charge or a levy that is imposed by government on citizens, that is individuals such as you and me, on companies, on investors, etc. That is basically the concept of the tax. Then we have discussed different types of taxation systems. One, we have discussed the concept of direct taxes as well as indirect taxes. What is a direct tax? Direct tax is basically the one where the tax burden cannot be transferred, right? You basically, government will impose the tax on the person, and the same person, taxpayer, of course, taxpayer will pay the tax. That is a direct tax. Whereas in case of indirect taxes, the government will impose a tax on a taxpayer, but the taxpayer will be transferring that burden to somebody else, right? They will transfer the burden to somebody else. That is called as indirect tax. Now, after that, the concept of specific taxes and ad valorem taxes. What is specific tax? Whenever the tax is imposed per unit, these are also referred as per unit taxes. Whenever government will impose a tax on, right, basically length or let's say height of a product, etc., that is basically referred to as a specific tax, right? That is on physical attributes government will impose a tax. Whereas in case of ad valorem, on the value of the product, on the value of the product, government will impose a tax. This is called as ad valorem tax. Right after that, we have discussed progressive, regressive, and proportional taxes. Progressive, as the income goes up, right? If the taxes imposed will also go up, that is called as progressive. Regressive means as the income goes up, right? The taxes will keep on decreasing. That is regressive. And proportional means doesn't matter, right? Whatever the income is, the taxes imposed and collected will remain same. Taxes collected will remain same. That is percentage will remain same. That is called as proportional. After that, we have discussed the concept of the countervailing duties, CVD. Countervailing duties, anti-dumping duties, and safeguard duties. Countervailing duties, CVDs, are basically anti-subsidy duties, where government of India, right? Again, assume it is government of India. Government of India, in order to offset the subsidies given by the exporting country, will impose additional taxes. That is the reason it is called as anti-subsidy or countervailing duties. Anti-dumping duty, a company, let's say exporter, the exporter will be artificially suppressing the prices, exporting at lower prices to India. And because of this, right, the government will impose a tax on this in order to offset this dumping activity. So this is called as anti-dumping duty. And the third one basically is right, a safeguard duty. Imports are competitive. Imports will suddenly rise up into India, and this will affect the domestic manufacturing companies. In order to protect domestic manufacturing companies or domestic companies generally, government will impose a tax on the imports, which is called as safeguard duty. So these are the three types. Now let me start with certain important direct taxes. Certain important direct taxes, then we'll shift to indirect taxes. Now, first type of the direct tax I want to discuss is the concept of income tax. The first type I want to discuss is the concept of income tax. Right. So this number one and number two is basically the concept of income tax here, right? As well as three. Now, what is this income tax? Simple. A taxpayer. Understand this point very carefully. A taxpayer. The taxpayer could be an individual, right? The taxpayer can be an individual, and the taxpayer can be even a company. And there are many other taxpayers, don't worry. For GS paper 3, just keep it very simple. An individual or a company which earns a certain amount of income, on this income, government will impose a tax and collect a tax which is referred to as income tax. Any problem with the first point? I'll repeat the statement here. There are different types of taxpayers, right? The taxpayer can be an individual, right? And the other one is a kind of a company, right? This could be a manufacturing company or a service company, etc., etc. So basically, whenever there is an individual or a company, they will earn certain amount of income. On the income, the government will impose a tax and collect the tax. So this is called as income tax. Now, these income taxes in India, whenever government wants to implement, collect income taxes, the powers are given to the government of India under the Act of 1961. Under the Act of 1961, that is Income Tax Act of 1961, has been passed by the government, and under this, the central government has the power. Center has the power. Remember this. Central government has the power to impose and collect taxes on such incomes earned. Now, over a period of time, all of you will agree now, Income Tax Act was passed in 1961. So there is a need to, right, basically review this Income Tax Act. So over a period of time, Government of India has made lot of amendments, changes to Income Tax Act of 1961. But earlier government, right, earlier government, when Mr. Manmohan Singh was the Prime Minister, the Government of India thought that we should restructure the direct taxes in India. We should restructure the direct taxes in India as well as indirect taxes in India. Simple. We should restructure the direct taxes as well as indirect taxes. And that is a precise reason the earlier government proposed a bill for this called as a direct taxes code. They proposed something called as a direct taxes code. DTC in short, direct taxes code. And in case of indirect taxes, they proposed goods and services tax. Now, GST was passed, the bill was passed by the government. Now, this is under implementation. Whereas direct taxes code has not been passed, the new government, because 2014 elections were conducted, a new government was formed, and the new government is of the opinion that we don't require a complete comprehensive restructure of direct taxes. We will make adjustment wherever it is required. And that is the reason we have not implemented direct taxes code, right, which was a restructuring of direct taxes in India. But on the other side, the restructuring exercise for indirect taxes has been completed. It is being implemented in case of India. Now, within the Income Tax Act of 1961, individual income taxpayers are also covered. Corporate taxpayers also are covered. That is, please understand, individuals such as you and me, we will earn income. We will earn income that is nothing but salary. We will earn income that is nothing but salary. On this income or salary, government will impose a tax and collect individual income taxes. What about the companies? For companies, right, the companies will earn profits. Any problem here? What about the companies, right? For companies, companies earn profit. On these profits, government will collect taxes, which is called as corporate taxes. This is referred to as corporate taxes. Done? So these are certain important points regarding the concept of direct taxes. Now, whenever you talk about individual income tax or corporate taxes, please understand how generally how the calculation is done. Now, imagine, right, understand this concept carefully. UPSC is not going to ask you this, but understand the logic. Imagine you are a person, you are a salaried person, and annually you are earning 10 lakh rupees. Annually, you are earning 10 lakh rupees. First and foremost, please understand this point. If your salary is 10 lakh rupees, government doesn't impose, I repeat, if your salary is gross salary is 10 lakh rupees, government doesn't impose the income taxes on all of these 10 lakh rupees. Is the statement okay? Anybody has a problem with this? I'll repeat the statement. If you are earning, right, if your gross salary is 10 lakh rupees, government doesn't impose taxes on full 10 lakh rupees. Why? Part of this 10 lakh rupees, you might take it, that is the receiver salary, you will take it and you will invest in, right, various instruments in the market. Correct? You will not use all the 10 lakh rupees to spend in the market. You will save money and you will invest in certain instruments in the market. For example, what if you make an investment in an instrument called as Public Provident Fund? Have you heard of this? PPF, very, very famous in India. Under Section 80C, there is one investment facility available to you, Public Provident Fund, PPF. PPF. There are many other investment opportunities. Let me take one more than sufficient. Public Provident Fund, PPF. Government says annually, if you make an investment up to 1.5 lakh rupees, up to 1.5 lakh rupees, right, in Section 80C, you can use it as a deduction. I'll repeat the statement. Annually, up to certain limit, right, you can make an investment under Section 80C. On this investment that you make under Section 80C, you don't have to pay taxes to the government. Which means, let me take the same number. If your salary is 10 lakh rupees, and if you take 1.5 lakh rupees and put it in the PPF, NPS, etc., etc., government will not collect taxes on this 1.5 lakh. Now, after this, what is your taxable salary? Right? This is your gross salary, or let's say, right, what you are receiving in the hand. From this, I will make certain deductions. Any problem with this? From this salary, I will make certain deductions. And after that, what is your taxable salary? The taxable salary will become 8.5 lakh rupees. 8.5 lakh rupees. And on this 8.5 lakh rupees, government will impose a taxes and collect income taxes from you. Now, any problem with this? Any problem with this? Please do let me know. Any problem with this argument here? So annually you are earning 10 lakh. From this, you will make certain investment, and these are called as a deductions. These are called as deductions. When you claim the deductions, whatever is left out, this is called as a taxable salary. On this taxable salary, government will impose the taxes and collect the taxes. Now I'm explaining this for an individual taxpayer. Follow this next point. We will use the next point again. Right? What is the next point? I've explained this for an individual taxpayer. Don't you think the same should be applicable even for companies? Let me know. Don't you think the same should be applicable? Same process. I'm not saying income. Same process. That is, imagine a company has earned a certain income. From the income, certain deductions should be allowed. And after that, whatever is left out, taxable salary or taxable profit, on that, taxes should be imposed and collected. Remember this point, because after some time, I will use the same thing. Don't keep on asking, why are you deducting this? Please remember this point. After some time, again, we will use this. Okay, this is point number one. Now, second point, in case of companies in India, Government of India has three important tax rates. On the profits, Government of India has three very important tax rates. First one is 22%, second one is 30%. There is a third tax rate on the companies, which is called as a 15% tax rate. Understand the difference between all. One is one type of corporate tax rate is 30%. Some of the companies will choose a 22% tax rate, and some of the companies are given one more advantage, 15% tax rate. Now, why there are three different rates for companies here? Point number one, if you are a company who wants to claim deductions? Let me know again after this. If you're a company who wants to claim deductions, then government will impose a corporate tax rate of 30%. Second point, if you're a company who do not want to claim any deduction, right, government says you can pay corporate taxes at 22%. If you are a company who is going to start manufacturing in this financial year, I repeat, if you are a company who is going to start manufacturing in this financial year, then government says I will give you one more advantage, that is you can pay corporate taxes at lower rate, that is 15% rate. Any problem in understanding, right, these three rates? Please do let me know. Any problem in understanding these three rates? I'll repeat it again. If you are a company who wants to claim deductions, you want to claim deductions out of taxes that you're paying, out of total profit you're earning, then the government says pay the corporate tax at 30%. And second, you want to pay the taxes but you do not want to claim any deduction, then government says pay the corporate taxes at 22%. And third, if you are a company who's going to start manufacturing only in this year, then I will give you an offer that is at a much lower corporate tax rate. You can pay the corporate tax rate at 15%. Right? At 15%. Those who start manufacturing, not the old companies, those companies which you start manufacturing this year, that is basically 15%. Earlier, this kind of a difference was not there. Earlier, this kind of difference was not there. Earlier, there was only one tax rate, 30%. Simple. Earlier, there was only one tax rate, 30% for all the companies in India. Whatever profits you earn, 30% of it, you will give it to government. Right? That was the concept of corporate taxes earlier. Now, why did Government of India introduce one more rate, 22%? Why did Government of India introduce one more rate, 22%? Why was this a new tax rate introduced? These are some of the reasons. Follow this very carefully. I've done a critical evaluation here. Please understand both the sides. Let's start with what kind of benefits are we expecting from reducing the corporate tax rate from 30% to 22%. What are the benefits? Point number one. When corporate tax rate is reduced from 30% to 22%, don't you think more and more investors would be attracted towards India? Let me know. If corporate tax rate is reduced from 30% to 22%, don't you think more and more investors, not only domestic investors, even foreign investors would be attracted to invest in India? And please understand, this is happening. This is happening at a point of time. Right? This is happening at a point of time where many companies, rather than locating only in China, they are looking at other countries to invest. I'll repeat the statement. This is happening at a point of time where many companies which were earlier present in China, they want to locate their manufacturing base out of China in many other countries. That is basically one advantage, one benefit that we are looking at. Now, some of you are saying over 250 crore tax rate is 30%. Earlier it was there, my dear. Earlier it was there, right? In fact, it was 250 crores. It was increased to 400 crore. But today we do not have that kind of a distinction. Please check the source. Please check the source. Earlier that kind of distinction was there. Now we are basically saying 30% if you want to claim deduction, no deduction 22%, right, etc. This kind of a taxation structure has been introduced. Now let me go to the next point here. Let me go to the next point. Second important point, or second very important advantage that we are looking at is this announcement was done by the government back in 2019 and 2020. Okay, this announcement was done by the government back in 19 and 20. Now at that point of time there was a slowdown in the economy. After that there was a recession. Correct or not? Please do let me know. Back in 2019 and 20, there was a slowdown experienced by the economy. And then the pandemic hit us. We experienced a recession in the year 20 and 21. So there was a slowdown in the economy. Now, please tell me, if more and more investment will start flowing in the economy, can you expect right? A virtuous cycle to be created in the economy? Let me know. If more and more investments will start happening in the economy, can you expect a virtuous cycle to get created in the economy? That was one of the expectation. Investments will start taking place. This will lead to virtuous cycle. That will lead to higher demand for goods and services, supply of goods and services, employment will be created, etc., etc. Right? This has been a long-standing demand of corporate sector in India. The corporate sector, that is private sector, has been asking the government of India to reduce the taxes for a very long duration now. Why corporate sector has been demanding a reduction in the taxes? Earlier, right, the former prime minister, the earlier prime minister, sorry, president, not prime minister, president of USA. All of you heard of Mr. Donald Trump? Let me know. All of you have heard of Donald Trump, right? You don't have to read. Have you heard or not? Mr. Donald Trump. When Mr. Donald Trump was the president of USA, the government of USA reduced the corporate taxes from 35% to 21%. Simple. They reduced the corporate taxes from 35% to 21%. Now, look at this. USA plus many other countries are reducing corporate taxes. India has kept it constant at 30% tax rate. Don't you think even the companies in India will start asking government of India, if other countries are reducing, why not government of India? Even government of India should start reducing the corporate taxes so that, right, the economy will become competitive, right? More and more investment will start flowing towards Indian economy. So this was a long standing demand. This was demanded by a lot of these Indian private sector companies. Okay, that is one more advantage or benefit. And the next advantage is there is a concept called as ease of doing business. There is a concept called as ease of doing business. Now, what is the meaning of ease of doing business? I'll give you the statement. Please remember this. Every time I keep on saying this will promote ease of doing business, apply the same logic there. Ease of doing business refers to any policy, or any measure of government, central government or state government, that will promote business activities in India. Simple, right? The ease of doing business refers to any policy or any measure of the government, either the central government or the state government, that will promote conducting businesses in India, that will make it easier to conduct businesses in India. Now, let me give a very simple example. Please tell me whether this will promote ease of doing business or not. Imagine you want to start a manufacturing facility in India, right? Example one. Imagine you want to start a manufacturing facility in India, and for that you require 10 licenses. For that you require 10 licenses. Now, under example one, what if I say you will have to go to 10 ministries, individually you will have to go to 10 ministries, apply for 10 licenses and get all of them individually from the 10 ministries. Whereas in the second example, I will say there is only one authority which has been established by the government. There is only one authority. You need to go to this authority, apply for all the 10 licenses from this authority. This is generally called as single window clearance. Have you heard of this? This is generally referred to as single window clearance. Right? What do you mean by single window clearance? Whatever approvals you require, whatever licenses you require, you don't have to go to multiple authorities to get these licenses. Only one authority will issue all of these licenses. Now, please tell me, if I move from the example 1 to example 2, can I say this is going to promote ease of doing business? Let me know. If I move from example 1 to example 2, can I say this is going to promote ease of doing business? Right? Can I give you one more example here? Have you heard of GST? Today we will discuss GST, by the way. Have you heard of GST? Goods and Services Tax. Don't worry about the long form. It is there at multiple places in the respective slides. We say that even the GST will promote ease of doing business. How? Let me give a very simple example here. Imagine you are a manufacturer of this bottle. You want to manufacture and you want to sell it in the market. Point number one. Point number two, you will manufacture and sell in multiple states. This is important. You will manufacture and sell in multiple states. Now, what was the problem here? Earlier, please understand. Earlier, what used to happen is the central government would have one indirect tax. Central government would have one indirect tax, and the states would also have indirect taxes. Indirect taxes on the sale of this product. But the difficulty will start increasing because whatever is the indirect tax imposed by Punjab government, whatever is the indirect tax which is imposed by the Punjab government on this bottle will not be the same as indirect tax imposed by, let's say, right, Assam government, will not be the same compared to West Bengal government, will not be the same compared to Tamil Nadu government, will not be the same compared to Karnataka government. Now, what is happening here? Can I use one statement? There were multiple indirect taxes. Is a statement okay with all of you? There were multiple indirect taxes. Now, rather than having this situation where there were multiple indirect taxes, we have shifted to a situation under GST where only one tax rate is imposed throughout India. Where only one tax rate, whether you sell this bottle in Karnataka, Tamil Nadu, Andhra Pradesh, Telangana, Bihar, UP, now doesn't matter, only one tax rate is imposed uniformly throughout India. Now, please tell me, is it not promoting ease of doing business? Let me know. Is it not basically ending up promoting ease of doing business? So, very often we'll keep on using this, right? That is the concept of ease of doing business. Understand the logic behind it. So, even corporate taxes, when these are reduced, it will provide benefit. It will provide benefit to the corporate sector. It will provide benefit to the private sector. So, we'll say this is going to promote ease of doing business in India. So these are some of the benefits that the government of India, right, with objective to achieve all of this, has implemented this policy where they have reduced corporate tax rate. Now, second, what are the issues or concerns? What are the issues or concerns? First one, if government will reduce the tax rate from 30% to 22%, just look at it. Is it okay if I say how much tax revenue government will collect will be affected? Let me know. Right, the first statement is if government will reduce the tax rate from 30% to 22%, don't you think how much tax rate the government will be able to, I'm sorry, how much tax revenue the government will be earned? That tax revenue will be affected. That is point number one. Second point is, have a look at this. Your objective is to increase, your objective with this policy is to increase investments in India. But please do let me know now, if you are willing to invest in India, is the corporate tax rate, is it the only factor you will consider to invest in India? Or apart from the tax rate, you will also consider how easy it is to get licenses in India. Point number one. How easy it is to acquire land in India. Are you able to get access to skilled labor or not? Etc. I hope you understand this. So whenever a foreign investor, or even for that matter, domestic investor wants to invest in India, tax rate is one factor that they will consider. But apart from the tax rate, they will also be considered, or they will also consider many other factors such as, can we get licenses easily from the government or it is very difficult to get? Do they have single window clearance, or I am forced to run from one ministry to another ministry? Is it easy to acquire land or it is very difficult to acquire land in India? Now, please remember this point. Acquiring land is very difficult in India. I'll give you examples. Acquiring land is very, very difficult in India. Can I give you simple examples? Have you heard of Silver Line project that was proposed in Kerala? Silver Line project, right? Those who are reading newspaper, they will know this. Those who are wondering what is it, there was one infrastructure project proposed in the state of Kerala. There was a large scale opposition, right? Yeah, there was a large scale opposition, and one of the opposition was that we will not allow you to acquire land. This project was dropped by the government. This project was dropped by the government. Or else, the best example, I'm pretty sure all of you know about this, Nano project, Nano car, Tata Nano project. Where was it initially supposed to be set up in India? In West Bengal. Did we end up manufacturing in West Bengal? No, there was a large scale protest against this land acquisition. As a result of this, this project later was shifted to Gujarat. And the most recent example, best example for you, what about bullet train project? What about bullet train project? What about bullet train project? Bullet train project was which is being implemented in two states now. That is basically Maharashtra and Gujarat. This bullet train project was supposed to start operating by now. We were supposed to start operating bullet train project now. But if you are reading newspapers, you will come across one article which says land acquisition is completely yet to be done for this bullet train project. We are still yet to acquire the complete requirement or required amount of land for construction of this bullet train project. And that is the precise reason now the deadline for completion of the project has been pushed back to another 2 to 3 years. Right? The argument is simple, right? Acquiring land is very, very difficult in India, very difficult and very costly also. So to get licenses, do they have a single window or it is very cumbersome process? Right? What about acquiring land? What about labor availability? So these are all the factors which are considered by foreign companies to invest in India. Now let me prove it to you. Let me prove this to you. How many of you have read the newspaper article in yesterday's Hindu newspaper regarding DLI? Let me check. Let me see how many of you are actually reading newspaper. How many of you have read that article in Hindu newspaper? Yesterday's Hindu. Whatever edition you have read doesn't matter. Right? There is an article on semiconductor scheme that is by the name of DLI. Now, if you have read it very carefully, there is one point which has been mentioned here. India has a huge amount of skilled labor to manufacture semiconductors in India. Yes or no? Those who have read the article, please do let me know. And those who are yet to read, please read that article. That is very, very important article. There is one point which is very clearly mentioned. Out of the total global number of engineers who are skilled to manufacture semiconductors, the article says around 20% of this skilled workforce is present in India itself. And that they say will work in advantage for India. That will basically mean that the foreign companies or even domestic companies can simply invest in India. Labor is already available in India. They do not have to skill them. They're already skilled for this. So I hope you understand when I say there are many other factors which are considered by the companies to invest in India apart from apart from the investments. And in the same article, there is one more concern. And this is the reason I ask you people to read that article. In the same article, there is one concern which has been raised. What is the concern? The article says the intellectual property rights in India regarding semiconductors. Correct me if I'm wrong. Right? Read that article. By the way, please read that article. The article says that one of the concern regarding that is whenever you design these semiconductors or fabs, etc., you will get right intellectual property protection. The research and development investment in research and development in India is very low, and the intellectual property rights that you have regarding these semiconductors is also very, very low in India. That they say is one of the very important concerns. Why? Right? You might see that this sector might not grow at a very faster pace. This sector might not attract a large scale investment. Okay, so again, right, please read it. This is my advice to you. Please read it. Okay, right. So investments depend upon many other factors apart from tax rate, and there are so many other policies. There are so many other policies that might basically hinder investments in India. Now, what do you mean by so many other policies? Imagine you want to manufacture this bottle in India. I'll take a very simple example. Imagine you want to manufacture this bottle in India, but to manufacture this bottle, you require certain import. You require certain import. This import, let's say steel, is not available in India. Hypothetical example, I'm saying. It's not available in India, or even if it is available, it is very costly. Now you want to import it. Simply want to import it from rest of the world. Government of India says, if you import it from rest of the world, I will impose higher import taxes. Customs is nothing but import or export taxes. Customs is nothing but taxes which are imposed on either imports or exports. Okay. So government says, if you import it, I will impose a higher tax on this. Now please tell me, if you want to manufacture this bottle, don't you think now you're in trouble? Trouble in the sense, you want a steel. If you import a steel, government will impose a higher taxes on the steel. But if you want to source it from the domestic market, the quality of the steel could be inferior, or the quantity is not sufficient to meet the demand. Now, don't you think these kind of policies might hinder these kind of policies might hinder lot of foreign investments in India, right? So this is one more concern. So on one side, you want foreign investments to come into India because you have reduced corporate taxes, but there are also many other concerns, right, regarding these kinds of investments that can take place in India. Done. So these are some of the issues. These are some of the benefits. Please go through them again once more carefully. Let me go to the next one here. Concept of capital gains tax. Concept of capital gains tax. Now, what do you mean by capital gains? Let me explain that first. What do you mean by capital gains? Imagine you purchase an asset. Understand the example first here. Imagine you purchase an asset. And when you purchase an asset, the asset can be a mobile asset or immobile asset. I'll give you examples here. The asset can be a movable asset or immobile asset. What is a movable asset? Let me give you an example. Let's say painting, gold, etc. Is the logic okay? Painting is movable? Yes or no? Painting is movable asset. And what about immobile asset? Immobile asset, best example is, let's say you purchase a house. You purchase a house or you purchase land, etc. Immobile asset. So you purchase an asset. I'll just take a simple number. Let's say at 1 crore rupees, and you will keep the ownership of the asset for certain time period. And after certain time period, you will sell the asset at, let's say, 2 crore rupees. You will purchase the asset at 1 crore rupees, and after certain time period, you will sell the asset at 2 crore rupees. Now, can I simply say, based on these numbers, can I simply say, by buying at 1 crore and selling at 2 crore, I've made a profit of 1 crore rupees here? Any problem in the calculation? Right? I've made a profit of 1 crore rupee. Now I'm using the term profit, but this is an asset. This is an asset. Asset is generally referred as capital. So Government of India says, this 1 crore, I will not use the term profit. Rather, I will call this as capital gains. I will call this as capital gains. So whenever you purchase an asset at a lower price, sell it at a higher price compared to the earlier price, this is called as, or the difference between them is called as capital gains. Any problem here? Any problem here? This is called as capital gains. And on this capital gains, government will impose a tax and collect a tax. Government will impose a tax on the capital gains and collect the tax. Now, before going forward, it's not that simple to calculate. I hope you understand. It's not like simply like this. They don't calculate it like this. Why? I'll tell you. Please tell me, you purchase a piece of land in 2020 and you will sell the piece of land in 2025. Simple question to all of you. Okay, you purchase a piece of land in 2020 and you sell the land in 2025. Don't you think between 2020 and 2025, inflation will be there in the market? Think of it. Don't you think between 2020 to 2025, there will be inflation in the market? Means, what is the purchasing power of money in 2020 will be different in 2025. So can we simply take this as 1 crore capital gains and impose tax on this 1 crore rupees? Obviously no. Government doesn't do that. Government doesn't do that. Why? The purchasing power of money between these 2 years has changed. Right? That is the reason I'll introduce one more term here. Whatever is the price that you have paid, they'll say we will provide you with indexation. Understand my statement here? Whatever prices you have paid, that is 1 crore rupee, I will not simply take it as 1 crore. I will provide you with the benefit of indexation. What do you mean by indexation? Certain indexation will be done using a index provided by the tax authority. From 1 crore, I will index. Index means connect. Simple. Index means connect, link. I will be allowed to change this number from 1 crore rupee to, let's say, 1.2 crore rupee, right? Looking at inflation rate, I'll be allowed to change this 1 crore rupee to, let's say, 1.3 crore rupees based on whatever is the index provided by the authority. So in that case, imagine 1 crore, you will be allowed to change it after indexation to, let's say, 1.2 crore rupee. Now please tell me, right, after indexation, the value becomes 1.2 crore and you have sold at 2 crore rupees. Can I now say capital gains is 0.8 crore rupees? Is the logic okay? Capital gains is 0.8 crore. On 0.8 crore, government will impose the tax and collect the tax. Hence, this is called as capital gains tax. Hence, this is referred to as capital gains tax, CGT. I'll repeat it again. Are listen to this, Baba. It's not difficult. You don't listen, that becomes a problem. You purchase an asset, you sell the asset. Is the first point clear? Purchase and sell. The asset could be movable asset or immovable asset. Now imagine you have purchased at price X, you sold it at price Y. You purchased at X, you sold it at Y. If a price Y is greater than price X, it is called as capital gains. Simple. Right? If Y is greater than X, then the difference between this is called as capital gains. And on this capital gains, government will impose a tax and collect the tax. That is called as capital gains tax. But what I'm saying is, from the time period when you purchased to time period when you sold, there will be inflation in the market. You might have paid 1 crore rupee back in 2020. But don't you think that 1 crore rupee, purchasing power of 1 crore rupee today will be different because of inflation? That is, if you purchase a basket of goods and services worth 1 crore rupee back in 2020, to purchase the same basket today, you might have to pay 1.2 crore rupees. Right? You might have to pay 1.3 crore rupees. That is the reason I said, rather than simply taking this as 1 crore, the tax authority will allow you to adjust it based on index that the tax authority itself will tell you. Right? They will tell you by how much percentage you are allowed to change your purchasing price. Indexation is allowed by how much percentage. Now, if they allow the indexation by 20%, your 1 crore will become 1.2 crore. Right? You have sold it at 2 crore rupee. After indexation, it is 1.2 crore. The difference between that will be 0.8 crore. On this, they will impose the tax and collect the tax. That is basically capital gains tax. That is basically capital gains tax. Okay. Now, there are two types. There are two types within the capital gains tax. One is called as a long-term capital gains tax, and second one is called as a short-term capital gains tax. Now, I'll give you one example. Listen to this very carefully. Listen first. You purchase the asset in 2020. You sell the asset in 2023. Don't worry about the dates. Don't worry about the dates. Please answer to a simple question here. For how many years you had the ownership of the asset? You purchased the asset in 2020, sold the asset in 2023. How many years you had ownership of the asset? 3 years. Right? I'll give you one more example. You purchased the asset in 2020, sold the asset in 2021. For how many years you had the ownership of the asset? 1 year. You purchase in 2020, sell it in 2022. What is the number of years you had the ownership? 2 years. 2 years. Now, they will use a technical term. They'll use a technical term. For the number of years for which you had the ownership of the asset, they will call this as holding period. Understand my statement here? I'll repeat it. For the number of years for which you had the ownership of the asset, they will refer to this as holding period. Now, is the logic okay? Example 1, holding period was 3 years. Example 2, holding period is 1 year. And example 3, holding period is 2 years. For how many years you had the ownership? That is called as holding period. Now, why this is important? Understand this carefully. When we introduced capital gains tax back in 1990s, when we introduced the concept for the first time, we took a uniform holding period of 3 years. We simply took a uniform holding period of 3 years for all the assets which were covered under CGT. That is simple idea. Understand this carefully. If the holding period is more than 3 years, then the tax imposed will be long-term capital gains tax. I'll repeat the statement. If the holding period was more than 3 years, then we impose the tax by the name of long-term capital gains tax. And if the holding period was less than 3 years, then the government would impose a tax which is called as a short-term capital gains tax. This was a uniform rate or uniform way to distinguish between what is long term, what is a short term when we introduced capital gains tax in the beginning. But over a period of time, what has happened is Government of India has made certain exemptions. That is, rather than keeping every asset holding period for 3 years, now for some of the asset holding period has been made 2 years. For some of the assets, a holding period has been made 2 years. For example, land holding period has been made 2 years now. For some of the asset, holding period is now 1 year. For example, shares. If you purchase a share in the market, sell it before 1 year, you will be imposed with short-term capital gains tax. If you purchase a share, sell it after 1 year, then you will be imposed with long-term capital gains tax. So understand the logic behind it. For some assets, holding period is 3 years. For some, it is 2 years. For some, it is 1 year. Don't you think the system is too much complicated now? Think of it. Don't you think the system has become too much complicated? There are so many complexities that has been introduced because of the change in the holding period for many of these instruments, many of these assets over a period of time. And that is the precise reason now there is a demand from various experts in the market that Government of India should restructure capital gains tax in India. Remember this. Government of India should look into restructuring, make it much more simple. Restructure the whole capital gains tax, right, into a simplified way. And that is basically the current affairs regarding the idea of a capital gains tax. Any difficulty? Can we go forward? Right? Any difficulty? Can we go forward? Question is, how can we identify on which it is 2 or 3? Government of India will tell you. Next step, when the budget is announced, government will give you details, which asset, right? What is the holding period, right? What should be the holding period? How much is the capital gains tax? Everything is given by government. You don't worry. And there is a very interesting question. Sir, what if I purchase the asset at 1 crore and sell it at less than 1 crore? Please, you only tell me, my dear. Right? Others also can pitch in. You purchase the asset at 1 crore, sell it at, let's say, 0.5 crore. Will you have capital gains there? Let me know. Will you have capital gains? No capital gains. So when there is no capital gains, how can we implement capital gains tax? It's a capital loss. I hope you understand. Okay. So this is basically discussion regarding capital gains. Now let me come to the next one. Important concept, tax avoidance. We'll discuss a lot of current affairs here. Please focus on the discussion. The concept of tax avoidance. Now very often you'll come across the term tax avoidance. I'll give you two terms here. One is tax avoidance and the other one is tax evasion. One is a tax avoidance, other one is a tax evasion. Point number one, it is same for both of them. Whether you talk about tax avoidance or tax evasion, what are you trying to achieve? What are you trying to do? Whether you're doing a tax avoidance or a tax evasion, you want to pay lesser taxes. You want to pay as much as possible lesser taxes. If I were to ask you, very simple question. If I were to ask you, would you want to pay more taxes or lesser taxes to government of India? I'm pretty sure most of you, may not be all of you, most of you will say, sir, if possible, I want to pay less taxes, and within that, if it is possible, I want to pay 0 rupee tax. Right? Again, that is for most of you. So argument is simple. Whether it is tax avoidance or tax evasion, you want to pay as much as possible lesser taxes to government. Point number one. Point number two, tax avoidance is not illegal. It is not illegal, right? Which means, right, this is not preferred. Tax avoidance is not preferred. But is it illegal? No, this is not illegal. Whereas tax evasion is purely illegal. I'll give you examples. Just give me a minute. Tax evasion is purely illegal, right? This is unethical. This is also unethical. This is also unethical. Now, let me give a very simple example. So what is the tax avoidance? I'll give you multiple examples, but tax evasion, let me give you one example. Imagine I'm a businessman. Okay, I'm involved in real estate business. I'm involved in construction of the houses and the sale of the house. What if at the time of payment of taxes, when I'm supposed to pay the taxes to government of India, my actual income is 10 crore rupees. My actual income is 10 crore rupees, but I will simply disclose to government of India and say my income is simply 1 crore rupee and I'll pay income taxes on this 1 crore rupee. Now please tell me, is it unethical? Yes. What is the objective here? I'm trying to reduce the tax liability, right, on my shoulder. And the third point, is it illegal? Is it wrong to report lesser income? Of course, yes, it is illegal to report lesser income to government of India. Right? This is basically the concept of tax evasion, idea of a tax evasion. And many people, many companies, many businesses are involved in evading taxes in India. Now, please tell me, if there is a tax evasion, will it reduce the tax collected by the government of India? What will happen to the taxes collected by government of India? All of you will agree, the taxes collected by the government of India, or for that matter, even the states, the taxes revenue will start falling down. It will reduce. Remember that. Now come to tax avoidance. Come to the concept of tax avoidance. Tax avoidance is not illegal, right? It is not illegal, but definitely yes, it is a unethical practice. It is unethical practice. It's not illegal, but it is unethical practice. And why do we do tax avoidance? Because we want to reduce the taxes that we are paying to government, either to the center or to the state. Now, how tax avoidance is done? How tax avoidance is done? Before that, what is the definition of a tax avoidance? Please have a look at it. Tax avoidance refers to certain actions that are taken by the taxpayers, as a result of which the tax burden or the tax payment done by this person will become lower. Very simple. What is a tax avoidance? It is, right, it is an unethical practice where companies, right, or the taxpayers will take certain actions, will do something, as a result of which the tax burden on these companies will automatically start coming down. Right? I'll give you multiple examples. Have patience, I'll prove it. And none of these actions that we're talking about, none of these are illegal. None of these are illegal. These are legal, but these are unethical practices. You're not supposed to do this, but you'll end up doing this in order to reduce the amount of taxes that you're paying to government of India. Now, let me give you one example. I'll give multiple examples, in fact. We'll connect it to current affairs as well. Listen to the lecture very carefully. Let me start with an example here. Tax avoidance. How can you do the tax avoidance? Example 1. There is country 1. Tax rate in country 1 is 30%. And there is second country. Tax rate in the second country is 10%. Now, before I go forward, let me ask you a very simple question. If you are a manufacturer of this bottle and you are earning profit, where do you want to pay the taxes on these profits? You want to pay the taxes in country 1 or country 2? Let me know. You want to pay the taxes on the profits of this bottle on country 1 or country 2? All of you will agree country 2. Any problem with this? Are Baba, those who are saying country 1, why? Why? Please tell me why. Why are you choosing country 1? You want to pay higher taxes to the government. Why? And so you will choose a country with a lower tax rate, country 2. But what if you have set up a manufacturing facility in country 1 itself? So let's say you are the owner of company A, which is basically manufacturing this bottle at 1000 rupee. You will take it across the border, sell it at 5000 rupees. Now do not complicate everything here. Point number 1, do not complicate. Point number 2, do not by heart calculations. UPSC will not ask you calculations. Do not by heart calculations. I just want to show you how tax avoidance is done. Now, question number 1, please answer this very carefully. Your company is registered in which country? Your company is registered in which country? Your company is registered in the first country. So, Are Baba. Right? Some of you are not even observing. Some of you are not even observing. You are manufacturing in first country, so you will say you are registered in the second country. How? Right? You are manufacturing here in country 1, so you are registered in country 1. So now is the logic okay if I say the company A will end up paying taxes, right, on the profits to country 1's government? Let me know. You're manufacturing in country 1, you're earning profits in country 1, you're going to pay taxes on these profits to the government of country 1. Second question, if you manufacture it at 1000, cost price is 1000, and you sell it at 5000, don't worry about taxes, don't worry about anything. Focus only on these numbers. If you have a cost price of 1000, you sell it at 5000, what is the profit you generated? What is the profit that you generated? Can I say 4000 rupee? Now you pay 30% tax on 4000 rupees. How much is the tax that you will end up paying in example 1? How much is the tax? 1200 rupee. Anybody has a difficulty here? Let me know right now. Anybody has a difficulty here? You manufactured a product at 1000, sold it at 5000, and you made a profit of 4000. On that 30%, 1200 rupees you paid the tax to country 1. Let me go to example 2. This is where tax avoidance will be observed. Let me go to example 2. In example 2, same thing. You have company A which will manufacture this bottle in country 1. Now, you will set up one more company in the second country. Understand this? Can you see this line? This line is border. Right? This line is border. Okay, so what you have done? You will manufacture this bottle in country 1. Now you will set up one more company in the second country. Is it illegal for you to set up a company in the second country? Question number 1. Start answering. Is it illegal for you to set up a company in the second country? No, that is not illegal. Point number 2. Now the company A will manufacture the bottle at 1000 rupee and will sell the bottle to the company B at 1200 rupees. Now tell me, is it illegal for one company to sell the bottle to another company? Think of it. Is it illegal? No, that is not illegal. But what happens now? Please understand. Company A will manufacture at 1000, sell it to company B, which is set up in the second country at 1200 rupee. Now, company B will sell it at 5000 rupees in the second country. Question number two. Question number two now. Please, based on the second example, please tell me how much is the profit earned by company A. Let me know now. Based on the second example, how much is the profit earned by company A? Company A. Can you understand what I'm asking you? Company A. Company A has sold the bottle at 1200 and has manufactured the bottle at 1000 rupee. Can I say company A has made a profit of 200 rupees? Many of you are making a mistake here. How difficult is it? Please tell me. My question was very simple. Company A earns how much profit? It earns 200 rupee profit. Company B is earning how much profit? Company B is earning 3800 rupee profit. Any problem? 3800 by company B. Now company A is present in the first country. Whatever profits they are earning in the first country, they'll pay 30% of that to tax in the form of tax to the government. So calculate 30% of 200. So the company in country 1 will pay 60 rupee. And company B, which is set up in the second country, I'll repeat, company B is set up in the second country. So they will pay the taxes to the second country's government. And that would be how much? 10% of 3800, that will be 380. Now look at the total amount of taxes paid by both of these companies which are owned by you only. Is it okay? Now look at the total taxes paid by the same, right? A same manufacturing company. Of course, what they have done is they have divided the business into two units now, owned by you only, owned by the same owner. But what has happened to the taxes paid by this company? Right? Earlier, to the country one, they used to pay 1200 rupee tax. Earlier to the country one, they used to pay 1200 rupee tax. In the second example, they are paying only 60 rupee tax to the government of country one. And the second country, they are paying 380. As a result of which, total amount of taxes they will end up paying. They'll end up paying is 440 rupees. Please tell me, right? Is it illegal here? Anything that I've told you, is it illegal? Do let me know. Anything about this is illegal? Absolutely no. This is not illegal. But is it unethical? Is it unethical? Of course, yes, this is unethical. And third important question, because of this, what is happening to the tax liability for the owner? Right? Because of this, what is happening to the taxes paid by the owner? Taxes paid by the owner will go down, will keep on going down. Is the logic okay? Can we call this as a tax avoidance? I'll give you more examples later, don't worry. UPSC is not going to ask you these examples. But tell me, now is the logic of tax avoidance okay with all of you? These are referring to various actions which are taken by the companies or the taxpayers, as a result of which the taxes paid will go down. Taxes paid will go down. And none of these actions are illegal. Right? All of these are by book, all of these are legal, but definitely as unethical. Okay, this is basically how tax avoidance is done. Now there is a term called as a transfer pricing here. There's a term called as transfer pricing. What do you mean by transfer pricing? Whenever one company will sell anything to another company, simple. Here is a company one. Company one will sell a product to company two. Now company two will pay price to this company one. Correct or not? Simple question, by the way. Nothing complicated here. Company 1 is selling a product to company 2, and company 2 will pay certain amount of money, that is price, to company 1. Anybody has a difficulty here? This is basically referred to as a transfer price. This is referred to as a transfer price. A party or a company may transfer goods or services to another party or a company for certain price. That is called as a transfer pricing. Now look at example 2. Look at example 2. Can I say transfer pricing is 1200 rupee in example 2? Look at it. Please look at example 2. Can I say in example 2 transfer price is 1200 rupees? Anybody has an issue with that? Company A is selling a product at 1200 rupees to company B. That's it. That is a transfer price. Now look at the next statement I'll say. Through transfer pricing, companies might be involved in tax avoidance. I'll repeat the statement here. Through transfer pricing, companies might be involved in tax avoidance. Yes or no? Statement is correct or false? If it is false, please tell me what is the problem with that. Where are you getting stuck up? Because if transfer pricing is there, and is it especially applicable for multinational corporations? Correct? This is especially applicable for multinational companies, because these multinational companies, MNCs, these are present across the globe. These are not present just in one country. These are present across the globe. So MNCs, there is a very high danger that these can be involved in a transfer pricing. Using that, they might be involved in the tax avoidance. Okay, can we go forward now? Can we go forward? Right? There are various measures that the government of India has taken. Other countries also as they're taking. I'll tell you what measures. Have patience. Now let me go to the next point. Follow this very carefully. Let me go to the next point. Many of you are asking, sir, if I'm the same owner, if I'm the owner of this company, why am I establishing one more company in the second country? Right? Why am I establishing, right, another company in the second country? Reason is simple, my dear. Don't you want to take the advantage of lower tax rate? Let me know. Don't you want to take the advantage of lower tax rate? Now, can I simply say, whenever the tax rates are different between two countries, two economies like this, these kind of tax avoidances will keep on happening. Any problem with this? Whenever the tax rates will keep on differing from one country to another country like this, these companies, these businesses will always try to take advantage of this situation. That is, taxes are different. I want to take the advantage of one of these taxes. Point number 2. Please look at example 1 and example 2. Please look at example 1 and example 2. From example 1 to example 2, can I say that the tax base of country 1 has narrowed down? Let me know. Can I say from example 1 to example 2, please make an observation. Example 1 to example 2, can I say tax base of country 1 has become narrow, has become smaller, and the tax base of country 2 has become wider. And because countries 1 tax base has become narrower or smaller, what will happen to taxes collected by country 1? Taxes collected by country 1 will go down. All of you agree? Taxes collected by country 1 will go down. That is one problem. Second one is, can I also say between example 1 and example 2, some of the profits which were earlier registered in country 1, now they will be registered in country 2. I'll repeat the statement. Some of these taxes which were earlier registered in country 1, now these profits registered means generated. Some of these profits which were earlier generated in country 1, now these will be generated in country 2. Can I call this as profit shifting? Let me know. Can I call this as profit shifting? That is, from country 1, profits are getting shifted to the country 2. Now I'll throw one term at you, very, very famous now: base erosion and profit shifting. Please look at the term here. The term is very simple now. This should be not be very difficult to you to understand. Base erosion and profit shifting. What is happening in country one? Please tell me. What is happening in country one? Can I say tax base in country one is going down? Correct or not? Please do let me know. And those who are asking what is tax base, right? Earlier class, Friday's class, you are not revising. You are not revising. Very simple argument. You are not revising. Is the tax base in country one going down or not? What do you mean by tax base? Any object on which you impose a tax and collect a tax. Very simple. Any object on which you impose a tax and collect a tax, that is called as a tax base. My income is a tax base. Profits of the company is a tax base. Now please tell me, if profits are getting shifted from country 1 to country 2, profits in country 1 will go down. What is meaning of that? Tax base in the country 1 will go down. And this tax base in country 1 is going down because of shifting of the profits from country 1 to country 2. This is called as base erosion and profit shifting. Any problem with the terminology? Please do let me know. Any problem with the terminology? The tax base in country 1 goes down. As a result of this, we'll call this as base erosion and profit shifting. Arey Baba, how difficult is it? What is tax base? You people don't revise. I'm very unhappy with this, right? Certain students here. Why? I'll tell you. What is tax base? You tell me. Tell me, what is tax base? And if you ask me, sir, you have not told me what is the tax base earlier, please look at slide number 3. What is a tax base? The object on which the tax is imposed. Object can be anything. It can be profit of the company. It can be income of certain people. It can be a capital gains. It can be anything. That is a tax base. Now, please tell me in this example, right? You people don't read, you don't revise, right? Suddenly you'll keep on asking everything in the classroom without revising. In this example, that is from example 1 to example 2, what is happening to the profits earned in country 1? Let me know. What is happening to the profits which are registered in country 1? Can I say profits registered in country 1? Country 1. Right? You don't even observe now. Country 1. Which side is country 1? Left side. Earlier, how much was the profit registered in country 1? Earlier, profits registered in country 1 was 4,000 rupees. Right? In the second example, what has happened? Profits registered in country 2 has fallen down to 200. Now, if the profits will come down, can I say tax base also has come down? At least now it should be okay with you. If the profits in country 1 has gone down, can I say tax base also has gone down? Right? Can I call this as a base erosion? Erosion means what? Reducing. Erosion is nothing but reducing. So can I call this as base erosion now? Of course, yes. But why is there a base erosion in country 1? There is a base erosion because, please again compare country 1 and country 2. Can I say between example 1 and example 2, the profits have been shifted from country 1 to country 2. Observe, 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 observe. Can I say profits, some of the profits have got shifted from country 1 to country 2. So there is a shifting of profit. As a result of this, there is a base erosion experienced by country 1. Any problem with this? If you do not revise, trust me, everything will become very difficult to you. Right? I will give a guarantee. I will give this guarantee to you. If you do not revise, everything will become difficult to you. Right? And again, please understand, let's not go 3 step forward, 2 step backward. 3 step forward, 2 step backward. It's not going to benefit anyone. Revise. Please revise. Okay? Now, can I call this as base erosion and profit shifting? Can I call this as base erosion and profit shifting? Yes. Now, there is a very famous acronym BEPS. Right? There is a very famous acronym base erosion and profit shifting BEPS. The BEPS refers to multinational enterprises exploiting the gaps as well as mismatches of tax policies between two different countries. It is basically representing that the mismatches in the taxation system which will be exploited by multinational enterprises. Okay. As a result of this, taxes collected by various governments will be very, very low. Now look at the next point here. You have a developed country such as USA. You have a developed country such as USA. You also have a developing country such as India. A developed country USA, a developing country India. Now, in case of India, the dependence on the taxes for the government is very, very high. Government of India, it is a developing country, and the dependence on the taxes, that is the money collected, the dependence is very, very high. And for a developed country such as USA, the government can generate revenues through various sources in addition to taxes. Now, because of this, we generally say that tax avoidance is done in both of these countries. USA also experiences tax avoidance. India also experiences tax avoidance. But the argument is because government of India is mainly dependent on the tax revenue for its income, the impact of tax avoidance on a developing country will be much higher compared to impact of tax avoidance on a developed country. I'll repeat it again. Understand? I'll repeat it again. Tax avoidance is done in both the countries, that is USA as well as India. But Indian government dependence on the taxes is very, very high. And if the tax avoidance is done in India, the impact of this on government of India will be much, much higher compared to the impact of tax avoidance on government of USA. Because in case of a developed countries, they will have many other sources in addition to taxes to generate revenue. That is not the same case for a developing country. And that is the precise reason what we have done is there are two groups of countries. One is referred as OECD economies. OECD basically stands for Organization for Economic Cooperation and Development Countries. OECD economies, and there is one more group of countries which is called as a G20, group of 20 countries. India is a part of G20. Now, OECD as well as G20 have come together, and they're saying these multinational enterprises are involved in base erosion and profit shifting. So what we will do is we will have one plan document. We will have one framework which is very famously referred to as BEPS action plan. There is one BEPS action plan. Under this action plan, there are totally 15 reforms which have been recommended. There are totally 15 action plans. There are totally 15 areas, 15 pillars. And these member countries are supposed to implement all these 15 pillars in order to address the issue of base erosion and profit shifting. Is India implementing this base erosion and profit shifting action plan? Yes, we are implementing. Is USA implementing this? Yes, USA is implementing. There are more than 140 countries around the world who are in the process of implementing the reforms which have been recommended in the BEPS action plan. Now, you do not make it complicated by highlighting all the 15 pillars. It is not at all required for UPSC. It is not at all needed for UPSC. Maybe at optional level, all of this is needed. But for GS paper 3, this much information is more than sufficient. Okay. Now, this is one concept. Let me go to the second one. Global minimum corporate tax. Very, very famous now. India is also party to this. We are also discussing the idea of a global minimum corporate tax. Now, what is this global minimum corporate tax? Under the BPS action plan, we are trying to implement this argument of global minimum corporate tax. Now, understand this very carefully. There are two pillars. There are two, right? Let's say reforms under the global minimum corporate tax. Pillar 1, it is applicable to multinational enterprises. Those who are typing what is MNE, MNE stands for multinational enterprises. So let me start with the first one here. Pillar 1 is applicable to all these multinational enterprises which have a revenue of more than 20 billion euros, which generate a revenue of more than 20 billion euros. Now, what is a pillar 1 say? Pillar 1 says part of their profits will be taxed in the countries in which they have generated the sales. Now, what is the meaning of it? Let me start with example. Understand the example here. All of you heard of Amazon company? Anybody in the classroom who says, sir, what is Amazon? All of you heard of company Amazon? Facebook, Apple, etc. Now, please understand, these are very, very important multinational enterprises. These are not present just in one country. These are present in different countries. Across the globe, these are present. Now, argument is simple here. Take example of a company such as Apple. Take the example of company such as Apple. Is Apple using the customer base of India? Think of it. Is the company Apple selling the products in India? Is it generating profits in India? Of course, yes. But when it is the question of payment of taxes on these profits, I repeat, when it is supposed to pay taxes on these profits, what they have done is they have registered in a tax haven. They are registered in a country which is generally referred to as a tax haven. And it is same with even Amazon, same with even the companies such as Facebook, that is Meta now, right? Even same with many of these global multinational enterprises. Now, what do you mean by tax haven? Tax haven refers to those countries. Tax haven simply refers to those countries where the tax rates are very low. Where the tax rates are very, very low or negligible. Understand this, right? The tax havens refers to those countries where the tax rates are very, very low or negligible. There are many countries around the world which will provide you, right, very easy process to set up a company. It is very easy to set up a company there, right? And the tax rates are many of the countries having 0% tax rates. Many countries will have 5% tax rates. Many countries will have 10% tax rates, right? So these are generally referred to as a tax haven. For example, have you heard of Mauritius? Think of it. Have you heard of Mauritius? Mauritius is a tax haven. Singapore, tax haven. Cayman Islands, British Virgin Islands. Have you heard of Panama? Very, very famous in the couple of years ago. Very, very famous for a couple of years, right? Panama Islands. All these are tax havens. All these are tax havens where it is very easy for you to set up a company. Tax rates are very, very low. Sometimes negligible, sometimes 0%. Now, if you're a company, don't you want to pay taxes in such economies where it is 2%, where it is 7%, compared to where it is 21%, where it is 32%, where it is 22%? So that is the reason what these companies do is, and these are very famous. These are famous for doing this only, right? Google, that is Alphabet company. Facebook, that is Meta company. Amazon, Apple, all these global companies, what they do is they will set up their offices, right? They will set up one office in the tax haven and they'll say all the profits generated will be, right, recorded by this office that we have set up in the tax haven. That is our office. That is our main office. And in this tax haven, if the tax rate is 2%, they will end up paying a negligible amount of taxes to the tax haven economies. Any problem here? Let me know. Any problem in understanding this? Right? What is the advantage for these countries? My dear, many of the times these countries will impose certain charges. Many of the times these countries impose conditions such as you will have to generate, let's say, right, 200,000 jobs in our country. You'll have to invest, right, at least $1 million in our country. So these kind of restrictions are imposed by these tax havens. So by imposing these restrictions in terms of minimum investment, minimum number of jobs generated, don't you think even this tax haven country is getting the advantage of it? Think of it. By imposing minimum charges on, let's say, $100 billion, right? By imposing minimum charges on $100 billion, don't you think they will make huge amount of earnings? That is the advantage for tax havens. But the problem for countries such as, let's say, India or for USA, don't you think this will be the problem? That is, the companies are using customers for India. From India, they are using customers. They are selling the products, right, to us, but they are not paying the taxes to us. Why should we allow them to continue to operate in India? Why should the government of USA allow it to continue to operate in USA? They will not be happy with that. That is the reason. Look at the pillar 1 now. Please look at pillar 1. Pillar 1 says part of the profits. Imagine you are generating profits in India. Part of these profits will be taxed in India only. Any problem in understanding pillar 1? Please do let me know. Can I go forward here? Can I go forward here? Now again, my dear, why are you complicating it? Did I say taxes when product is imported, taxes will be right imposed, right? The transportation cost is also there. All of that is considered, but why do you want to complicate it? You want me to calculate step by step. Transportation cost, add this much. Product is imported, add this much. Why? Why do you want to complicate it? Understand the concept. And by the way, did I ask you to buy out any of these calculations? Let me know. Did I ask you to buy out any of these calculations? I said, don't buy hard them. UPSC will never ask you these calculations. Okay? Come to pillar 2. That's the reason. Understand the concept, not the calculation. Calculation, waste of your time. Let me go to pillar 2 here. In case of pillar 2, one of the reason why base erosion profit shifting happens. I repeat, one of the reason why base erosion and profit shifting happens is that tax rates are different in different countries. Right? I hope you understand. The tax rates are different in different countries. If you remember the earlier example, in one country the tax rate was 30%, in another country the tax rate was 10%. Now companies, multinational enterprises automatically will start moving their products towards the country where the tax rates are very low. That is the reason there is a second pillar. Under the second pillar, the multinational enterprises will be subjected to a minimum 15% corporate tax rate. A minimum 15% corporate tax rate. Now, how this will work out? Let me explain this. Follow the process carefully. Understand the process. The minimum tax rate will be 15%. Meaning what? Let's imagine there is one company in India. The company originated in India. I will call this as a source country or origin country. Okay. So the company originated in India, it's an Indian company. But for the purposes of payment of taxes, this company is registered, let's say, in right Panama Islands or Mauritius for that matter. Don't worry. Right. So the company is an Indian company, but for the payment, for the purposes of payment of taxes, they're registered in Mauritius or in Panama, where, let's say, hypothetical number, the tax rate is 4%. Where on the profits that they've generated, they will have to pay 4% taxes. Now, let's say hypothetically, this company has generated a profit of 100 crore rupees. Hypothetically, let's say this company has generated a profit of 100 crore rupees. Now, can I simply say that to the government of Panama or to the Mauritius government, the company will pay 4 crore rupees in the form of taxes? Any problem with the calculation? Step 1, the company will pay 4 crore rupees to this government. But now under pillar 2 we are saying minimum tax rate has to be 15%. Minimum it should be 15%. Now how are we going to enforce 15%? Because in Panama it is only 4%. How are we going to ensure it will be 15%? Now please find out the difference between 15%, that is the tax rate, minimum tax rate, and the tax rate which is paid by the company. The company has paid only 4% tax rate. What is the difference? 11%. Now the government of India will impose 11%, 11% tax rate on this profit and collect it. The government of India will impose 11% on this profit and collect the taxes from the company. Any problem in understanding this calculation, please do let me know. And by the way, do not by heart the calculation. Understand the logic. Whatever taxes you are paying, if it is less than 15%, then the difference between 15 and the taxes rate that you're paying, that will be calculated, and right, the origin country, the source country will impose and collect it. Please explain again. Are Baba. Right, imagine there is a company which is an Indian company. It is an Indian company, but for the payment of taxes, they are registered in, right, a tax haven where the tax rate is 4%. What is the minimum tax rate as per pillar 2? Please look at statement 1 here. It's not difficult. You people don't focus. What is the minimum tax rate as per pillar 2? Focus on point number 1. Tell me, what is the minimum tax rate? 15%? Any difficulty here? Arey Baba, it is there in the slide only. Minimum tax rate is 15%. But now tell me, this company, let's say company ABC, this company ABC, for payment of taxes, it is present in Panama. In Panama, let's say corporate tax rate is 4%. Corporate tax rate is 4%. Now, please calculate, right? Use your calculator. Please calculate what is the difference between 15% and 4%. What is the difference? 11%. Any problem here? 11% is the difference. And this company is an Indian company. Now, government of India will impose 11% tax rate on the profits generated by the company and collect it. This is how, right, basically they will work out. Let me ask you another question. I will ask your CSAT now. I'll test your CSAT. Imagine there is company XYZ. It has generated a profit of 700 crore rupees and it is paying a tax of, right, let's say it is paying a tax of 3% for country A. Now, please tell me how much will be the additional tax imposed by government of India in terms of numbers, in terms of rupees. Calculate and tell me. Right? How much will be the amount of money that will be imposed and collected by government of India? Don't tell me percentage, tell me numbers. Tell me rupees. Right? All of you will agree it will be 12% of 700 rupees. I'm sorry, 700 crore rupees. 12% of 700 crore. That will be how much? 84 crore rupee. This will be how new minimum tax rate of 15% will be imposed. Now, if this is done, you will understand what is the advantage with this. If this is done, please tell me, if you are owner of the company, will you not prefer having a company within India, registering in India, paying taxes in India, rather than paying taxes somewhere else? Think of it. If this kind of a taxation policy is implemented across the globe, right, don't you think the idea of taking an advantage, setting up your company in some other country for the purpose of payment of taxes, that will be addressed? Now, these companies will start moving towards, right, their respective home countries. That is the logic here. That is the logic. Right, so this is basically the concept of pillar 2. Pillar 1, wherever you're generating revenue, part of the profit will be given to that country. Second one, right, overall tax rate on the profit incurred by the company should be minimum 15%. This is a pillar 1 and pillar 2. Is India implementing these policies? Not yet. Please understand, this is just a proposal. We, as of now, do not know how it is going to work out. How much will be given to country 1, how much will be given to country 2. We do not have any clarity regarding this. It is just being discussed. India is one of them. India is one of them. Right? This is basically, right, the global minimum corporate tax, GMCT. Any problem here? Right? Any problem? Sir, if source country is India, how can the company get registered in Panama? It should be registered in India by default, my dear. It is allowed. Right? Can you understand what I'm saying? It is allowed. For example, right? The four biggest multinational enterprises: Google, Google, right? That is Alphabet company, Meta, Facebook, right? Or for that matter, Amazon, or for that matter, Apple. All these are American companies. All of you will agree. All these are American companies. But do you think they're paying the taxes on their profits in America? Let me know. Do you think they're paying the taxes on their profits in America? If you say yes, then you're mistaken. You are solely mistaken. If you don't trust me, go to Google and search. Search about Google in Google only. Right? You will realize that for the purposes of payment of taxes, they will have offshore offices. They use the term offshore offices. They will set up offshore offices, right? Where they will simply say this offshore office is our main office. And any profit that we are generating across the world, that will be reported in this office. And this is not illegal. Please understand, it is not illegal. Many of you are not believing what I'm saying. It happens. It happens. It is not illegal. They will do that. Right? If you don't trust me, right, you can check it later. Where does Google pay their taxes? On the profit. Where does Amazon pay taxes? Where does Shell pay taxes? Check it. You will realize they are paying taxes somewhere else outside USA. Okay? Done. Now let me go to the next one. Minimum alternate tax. We can discuss hours and hours together on basically that idea itself, but that is not required. So much of information is not required for UPSC. That is not required. You don't worry. Next one is concept of MAT, minimum alternate tax. Understand this very carefully. Many of you again will try to do a PhD on this. Just understand the basic idea. Point number one. Point number one. Any company that is operating in India, any company that is operating in India will publish a certain documents. One of the document is called as profit and loss account. One of the document is called as profit and loss account, P&L account. Commerce students will be very, very happy now. P&L account. Right? One is called as a profit and loss account. And the second one is basically a balance sheet. Now, what do you mean by a profit and loss account? In case of profit and loss account, the company will provide you information regarding how much is the income or revenue they have generated, right? And how much is the total expenditure they have incurred. Any problem with this? What do you mean by profit and loss account? Right? As per Companies Act and Income Tax Act, they will prepare profit and loss account. In P&L account, right, what they provide with you, right, what they provide to you people is simply how much is the total revenue they have generated and how much is the total expenditure they have incurred. And think of this, please think of it. If the revenue is greater than expenditure, if revenue is greater than expenditure, right, basically this is called as book profit. If revenue is greater than expenditure, this is called as a book profit. Now, many of you will start typing, what is book profit? Please understand this. Book profit simply means the profit is generated in the account book. I'll repeat. Profit is generated in the account book. They are yet to receive these profits. They are yet to enjoy these profits because a lot of adjustments will happen from book profits. Is the logic okay? Why this is called as a book profit? They are entering all of this data in a book traditionally. Don't say, sir, we are using computer now. Think of traditional concept, right? 200 years ago, 300 years ago, right? Do you think everything was entered into a laptop? Everything was entered into a Google sheet? No. Earlier, they used to maintain books of accounts for all of this. And that is the reason why this is referred as a book profit. Now, understand the next important point here. Understand the next important point. From the book profit, now certain deductions will be allowed by Government of India. Any problem with the term deduction here? From the book profit, certain amount of deduction will be allowed by Government of India. And once you claim deduction, whatever was left out was referred to as taxable profit or taxable income. Taxable profit or taxable income. Any difficulty here? Please do let me know. Any difficulty? It's a very simple process. Do not complicate it. It's a simple process. Follow this very carefully. The company will publish one statement which is called as profit and loss account. Right? What do they provide in profit and loss account? They will give you details of how much is their total expenditure, how much is the total revenue they have generated. And assuming revenue is greater than expenditure, this is called as a book profit. Now government will allow certain deductions to be claimed by the company. Now many of you will start asking what kind of deductions are allowed. For example, depreciation. Have you heard of depreciation earlier? Think of it. Have you heard of depreciation? Depreciation, right? Dividends which are distributed, etc., etc. Lot of these deductions are allowed. And once the deductions are allowed, whatever is left out after deductions are done, this is called as a taxable profit. And the government will impose corporate tax. Government will impose the corporate tax on this taxable profit and collect the money from the company. Any problem with the sequence here? Do not do a PhD on this. Trust me. Please do not do PhD on this. We can talk hours and hours on this. Is it required? Absolutely no. If you do not trust me, open any book that you have, check whether they are giving you all of this. They will not give you, you don't worry. Any problem with this sequence here? Now, why I'm explaining all of this? There is a term called as zero tax companies. There is a term called as zero tax companies. Now, what do you mean by zero tax companies? Zero tax companies are those companies which will have large book profits but claim large deductions in such a way that the taxable income or taxable profit will become zero. I'll repeat the statement here. What are these? Right, zero tax companies. These zero tax companies are very, very large, right, companies which will generate huge amount of book profit, but also claim huge deduction, thereby reducing the taxable income or taxable profit to 0 rupees. And once taxable income becomes 0 rupees, if the government of India has a corporate tax rate of 30%, how much will be the taxes collected by the government here? How much will be the taxes collected by the government? Government will collect 0 rupee tax. And because government is collecting 0 rupee tax, these are referred to as zero tax companies. Any difficulty here? Any difficulty? Again, right? Please listen to my statement. Do not become an expert in this. Many of you are asking, sir, show me how deductions are calculated. You want to learn about section 115 of Income Tax Act. Let me know, you want to learn about section 115 of Income Tax Act. Not required. I can talk. I know about that section. I can talk. But is it required for you? Do you need that for UPSC? No, you don't need it. So don't waste your time. Right? Do not waste your time. Section 115 talks about minimum alternate tax. Okay? So argument is simple. Generate book profit, claim deductions, and right, basically ensure that taxable profit becomes zero. And government will collect 0 rupees. Now, if you are the Prime Minister, tell me, will you be happy with such companies? Right, let me know. Will you be happy with such companies? Arey Baba. Right, some of the students unnecessary. Tell me, do you remember the concept of dividend? Let me know. Do you remember the concept of dividend? Have I discussed this in the morning batch? That is what I'm trying to ask you. Do you remember the concept of dividend? I'm pretty sure I'll discuss this in the beginning only, in the first week, in every batch. Arey, don't say no. I'm pretty sure I've discussed it. I'm pretty sure. And 99% of the students are saying yes, which means I've discussed. Basically, part of the profits will be taken and given to the owners of the company. Part of the profit will be taken and given to owners of the company. That is called as a dividend. That is called as a dividend. And that is called as dividend. Now, please understand, imagine there is a company. Okay, imagine there is a company. It has registered a book profit of, let's say, 100 crore rupees, and they will distribute a dividend to the shareholders. They'll distribute a dividend to the shareholders. Let's say, right, 80 crore rupees, which means if you deduct this dividend 80 crore rupees, taxable profit becomes 20 crore rupees. Now look at the irony of the situation. Please look at the irony of the situation. The company has profits, so much profits that they are distributing it to the shareholders. But when it comes to the question of payment of taxes to government, how much taxes will they pay to the government? 30% of 20 crore, that is a taxable income or taxable profit, they will give 6 crore rupees to government of India in the form of taxes. Don't you think government of India will never be happy with such a situation? Think of it. Right? If you're the government of India, will you be happy with this kind of a situation where companies generate lot of book profit, announce a lot of dividends to the shareholders, claim a depreciation, etc. as a deduction, but when it comes to payment of taxes to the government, they will pay negligible taxes or 0 rupee tax. Right? That is the reason these are called as zero tax companies. Now, if you keep on asking what deductions they will claim, no point in discussing that. I will not tell you. I've given you one deduction, more than sufficient. Okay. Now, these companies will end up paying 0 rupee tax to the government. That is the reason government back in 1987 introduced a system by the name of minimum corporate tax. Right? The minimum corporate tax, MCT, minimum corporate tax. Now, how this minimum corporate tax will work out? Let me show another picture to you. Please look at the picture. Please look at the calculation. Revenue of the company is, let's say, 1000 crore. Expenditure incurred by the company is 800 crore. And the book profits generated by the company is 200 crore. Now, right, the government will allow the company to claim reductions and arrive at a taxable income or taxable profit of 0 rupees. But under the MAT system, I repeat, under the MAT system, what government now says is, I will calculate taxes on two different numbers. One, I will calculate a 30% of the taxable profit. I will calculate a 30% of taxable profit. And I will also calculate, and I'll also calculate 15% of book profit. Any problem here? Earlier, only this calculation was done. Now, under the MAT system, government says, I will also calculate 15% of book profit. If 15% of book profit is greater, I will collect that in the form of tax from the company. For example, 15% of 200 crore is how much? Please tell me. 15% of 200 crore is how much? 30 crore rupee. 30% of 0 crore is how much? 0 rupee. Which is bigger one? Which is a larger number? 30 crore rupee. Government will collect this in the form of a tax from such companies. The government will impose and collect this 30 crore rupee in the form of tax from such companies. Any problem here? There is a double taxation. Where is double taxation? Let me know. Are we imposing two taxes here? Are we collecting two taxes? Double taxation means two taxes. Are we collecting two times the tax here? Are Baba, think of it, no? Where is the two times? I'm saying either I will collect this or I will collect this. Whichever is greater, I will collect this in the form of a tax. That is basically the concept of minimum alternate tax. Sir, what will happen if this 30 crore is less than this number? Then I will collect this in the form of taxes. Simple. Imagine, I'll give you an example. Imagine rather than 200 crore, the company will claim deductions of 20 crore. Simple, understand this. Rather than 200 crore, imagine the company will claim deductions of 20 crore. What will be taxable income? What will be taxable profits here? 180 crore. Now calculate 30% of 180 crore, you will get 54 crore. Government will say 54 crore is greater. I will collect this right from the company. Simply collect 50 crore, 54 crore rupees from the company. Done? Right. So this is basically how minimum alternate tax, MAT, minimum alternate tax will be imposed and collected. Any problem here? Again, don't worry about deductions. Even if you keep on asking, I'll not answer it because it is useless for UPSC. It was introduced for the first time in 1987 when Mr. Rajiv Gandhi was the Prime Minister. It was announced in 1987 but actually came into implementation from 1989. It was targeted at some of these companies which made a huge amount of book profit but also claimed huge deductions. As a result of this, ended up paying negligible taxes or no taxes at all to the government of India. And from 1996, from minimum corporate tax, it was renamed as a minimum alternate tax. And right now, the minimum alternate tax, MAT, is 15%. It is applicable to all the companies in India which are claiming deductions. It is 15% applicable. Any issue? Can we go forward? Any issue? Right? Don't keep on asking about deductions. Don't waste your time. Right? Unnecessary things you are worried about. Okay? Because let me ask you to do one simple exercise. If you say, sir, I want to learn everything about how P&L is calculated, how book profits are calculated, how MAT is calculated, do very simple exercise. What is a simple exercise? The concept was introduced back in 1987. Please check last 10 years question paper. Check last 10 years question paper in UPSC, both prelims and mains. Show me one question where they have asked you to calculate deductions. Think of it. Right? This is how you understand what is necessary, what is unnecessary for UPSC. Show me one question where they've asked you to calculate deductions, right? Giving you a table or giving you certain numbers. Not required. Don't waste your time. Now, next concept, idea of a GAR. Important for UPSC. Concept of GAR. What is GAR? GAR stands for General Anti-Avoidance Rules. Right? It's not agreement. It is a rules. General Anti-Avoidance Rules. That is a long form. Now, what is this general anti-avoidance rules? Point number one. In fact, it is a question for you people. Please tell me, last week, did I discuss you what is a feature of special economic zone policy? Let me see. Let me know. Friday. I'm pretty sure I've discussed that. Right? Do you remember what is the feature, speciality about special economic zone? The speciality is very simple. If you set up a manufacturing facility in the special economic zone and you earn a profit for 5 years, I will give you 100% tax exemption. I'll give you 100% tax exemption. Meaning what? Imagine an example. You're a company, you are earning a profit of 100 crore rupee outside SEZ. Is it okay? You are earning 100 crore rupee profit outside SEZ. If you earn 100 crore outside SEZ, I will impose 30% tax collected from you. But if you are present within the special economic zone for 5 years, I will give you 100% exemption. Meaning what? Whatever profits you generate, I will not take a single rupee from you in the form of corporate taxes. In the form of corporate taxes, I will not collect even a single rupee from you. That is a speciality about special economic zone. Now, if you remember the picture, I had given the picture like this. I said, imagine this is India. I said, imagine this is India. And, right, imagine this region is a special economic zone. This is a special economic zone. Now, what about the remaining area? What about remaining area? I will use a different, right, color now. The remaining area, that is the orange colored area, will be referred to as domestic tariff area. Is it okay? The remainder part, the remaining area outside SEZ This will be referred to as a domestic tariff area. Any problem in understanding SEZ and DTA? Can we go forward? Any problem in understanding what is SEZ and what is DTA? That is, let's say, whole of India, any region outside SEZ will be referred to as domestic tariff area. Now, why? Why this is important? Why you need to understand this concept? Let me give an example of how GAR will function. How general anti-avoidance rules will be implemented. Let's start. Imagine you're a manufacturer. Same argument, right? Earlier we have discussed this. Now we will apply this within India, right? Have a look at this. You're a manufacturer of this bottle. You're present in the domestic tariff area and you will generate a profit of 100 crore rupees. Start with example 1. You're a manufacturer. You're present in domestic tariff area and you generate a profit of 100 crore rupees. Now, can I simply say that the government will impose a tax of 30% on your profit and collect corporate taxes from you. Right? Collect corporate taxes from you. Now come to the second example. Come to second example. What you will do is you are already manufacturing the bottle within DTA. I repeat, you are already manufacturing the bottle in the DTA. Now what you will do is you will manufacture the bottle in DTA, sell it at a lower price to one more company that you establish, right, in SEZ. Same logic that we have discussed earlier, but we have introduced SEZ now, right? You are manufacturing this bottle, right, company B in the DTA. You will sell it, let's say hypothetically. I'll take earlier number so that you understand it. Earlier you manufactured at 1000 rupee and you sold it, let's say, at 4000 rupees, thereby making a profit of around 3000 rupees. Now what you will do, you will manufacture the bottle at 1000 rupee in company B, which is part of DTA. Now you will sell it, right, at let's say 1200 rupees, right, to a company A which you have established but in special economic zone. In special economic zone. And now you will export it to the international market, let's say at same number 4000 rupees. Now follow the same calculation. Same calculation. How much is the profit generated by company B? Tell me now. How much is the profit generated by company B? Company B, I'm asking you. 200 rupee. Company B generates a profit of 200. Company A generates a profit of how much? 2800 rupees here. Now, on this profit, how much taxes will be paid to the government of India? On this profits, how much will be the taxes paid to government of India? 0 rupees. On this profit, how much taxes will be paid to government of India? 60 rupees. Now, if you apply the same logic in the previous example, that is example 1, 1000 rupee, 4000 rupee, you ended up making a profit of 3000 rupee and you'll pay 30% tax on this. That is, you will pay a tax of 900 rupee to the government. From 900 rupees, and now you have reduced the tax burden to 60 rupees. Any problem with this? Any problem with this? But now understand what government will do. Understand what government will do. Now, don't you think government of India, that is the tax officials, when you submit all of these details, that is, you submit the documents to the tax officials, which shows that company A is owned by you and it is present in SEZ. Company B is also owned by you. It is present in the domestic tariff area. And there is a sale that is taking place between company A and company B. Now, in this example, let me know, right? Look at the statement and please tell me. In this example, is there any other objective that you have apart from avoiding taxes? Look at this. Why are you establishing one company in domestic tariff area and why one more in SEZ? What is the logic behind it? Is there any other commercial substance? Is there any other commercial substance? Is it that labor is available only in the SEZ? Is it that raw material is available only in the SEZ? So don't you think, rather than having any kind of a commercial substance in such arrangement, it is more to do with the tax avoidance? Is the logic okay? Rather than having any other commercial substance, there is not much commercial substance. The most important objective that you have in your mind is to avoid taxes. So government of India, that is a tax official, will say these kind of arrangements that you have entered into, these kind of arrangements or agreements that you have entered into, these are done predominantly to avoid taxes. And because you are trying to avoid taxes, and for that purpose you have entered into such arrangements, I will not give you the benefit of tax exemption. I will not give you the benefit of tax exemption. I will not give you the benefit. Meaning what? Whatever profits you have generated by establishing company A in the SEZ, on that, what was the tax exemption? 100% tax exemption was provided. Now, tax officials will say, no, I will not give you that tax benefit. You will also have to pay taxes at 30% corporate tax rate. Right? This is done under the concept of general anti-avoidance rules. This is done, right, basically under the concept of general anti-avoidance rules. Any problem with this? Any problem with this? Please do let me know. Why to establish in DTF at all, my dear? Even before SEZ, imagine you have set up a manufacturing facility, very, very huge manufacturing facility outside the domestic, outside the SEZ. You have invested crores of rupees. You already have a manufacturing facility in, right, let's say, a domestic tariff area. Now, can you simply shut it down? Think of it. Can you simply shut it down, right? Incur huge amount of expense for that and move everything into SEZ. That will require lot of expenditure on your part. Or else, can I give you one more example? What if you're located in a certain region where you've made substantial amount of investment? There is no special economic zone anywhere nearby. You want to close this company, move your manufacturing into another state. Then you'll have to search for labor. You'll have to search for right raw material supplier. You'll have to first construct the manufacturing facility in the SEZ, etc., etc. So that is the reason. Please understand, there are a lot of complications here. It's not that easy, right? Many of you simply say, sir, I will close company B and I'll directly open company A. You can do that if it is feasible for you, right? But in many cases, that is not economically viable for them. That is the reason they will try to, right, basically abuse the taxation system. I hope you understand my statement. That is the precise reason why they will try to abuse the taxation system using these loopholes in the taxation system. And the tax authorities, right, will use, there are powers given to the tax authorities under GAR. The tax authority will simply say, whatever arrangement you have, whatever agreement you have between company A and company B, it is impermissible avoidance agreement. Impermissible avoidance agreement. What is this IAA? It is an arrangement which has been done in order to avoid taxes and does not have any kind of a commercial benefit. Right? Can I say this example 2 is a prime example of IAA? Look at it. Right? This example 2 is a prime example. Are Baba, after this I'll give break. Focus on the discussion. No. Focus on the discussion. Why concerned about the break? Those students who are asking for the break, all the best for UPSC mains examination then. All the best. You will realize, right? Then you will realize how difficult it is to sit for longer duration. Okay, focus on the discussion. So can I say example 2 is a prime example of impermissible avoidance agreement? Because in the example 2, is there any commercial benefit? Is there any commercial benefit? Are Baba, I am explaining that, you are asking that only. I am explaining the same thing, IAA. Please look at example 2. Those are asking what is IAA, look at example 2. You already have a manufacturing facility in the domestic tariff area. You will set up one more company within the SEZ. You will sell it from company B to company A and export it to international market. Register huge profit in SEZ, register lower profit in DTA. Now, please understand this arrangement that is existing between company A and company B. Is it not because you want to avoid taxes? Let me know. Those who are saying it is very difficult, let me know. The arrangement that is existing between company B and company A, is it not to avoid taxes? Otherwise, what is the requirement? What is the requirement of this kind of an arrangement? There is no requirement. So the argument is this does not have any commercial right requirement or a commercial benefit. The only reason you have this kind of a transfer pricing is because you want to avoid the taxes, right? Because you want to avoid the taxes. That is the reason the tax authorities under GAR, they have power under GAR. GAR is nothing but a guideline, set of guidelines. So under GAR, the tax authorities will simply say, because this is an impermissible avoidance arrangement, I will not provide you any tax exemption. You are supposed to pay taxes at 30%. Please pay 30% of taxes. I'm sorry, 30% of the profits that you have generated within SCC in the form of taxes. Done. This is basically how GAR will work out. Have a look at this. Companies enter into various arrangements which lack any commercial substance. Rather, these are made in order to reduce the tax liability. In order to reduce the tax liability. GAR refers to a set of provisions or guidelines, right, which are used by the tax official to basically find out if there are any impermissible avoidance agreement, and any tax benefit that is given to the companies, that tax benefit will be withdrawn. Whatever is the normal rate of tax applicable, that will be imposed and collects. Right? Look at the term here. GAR focuses on substance over form. Right? What do you mean by substance over the form? In the second example, there is a commercial agreement between company A and company B. There is an agreement. But what is the reason? Why this agreement has been signed? What is the substance? Substance means what are the details of the agreement? Is it done just to avoid the taxes? Or is there any commercial benefit of these kind of agreements? So substance is important over the form of the agreement. Okay. Under this, tax authorities are empowered to deny tax benefit. Any tax benefit that is given, that will be withdrawn. GAR provisions will come under the Income Tax Act of 1961. Earlier, this was proposed under the Direct Taxes Code, but it was not implemented as a direct taxes code was not implemented in India. But now, right, Government of India separately implemented the concept of general anti-avoidance rules. Right? Anything else you want to discuss regarding this? Any doubts that you have? We'll take a break, but before that, if you have got any kind of questions, please do let me know. And limit your questions. Limit your questions to what is required for UPSC. Don't worry about unnecessary things. Do not worry about unnecessary things. Okay. Why fully 15% tax is levied by other countries as their population is used to generate MNC's profit? Why only remaining 4%? Arey Baba, tax havens will have very less rate of taxation. Tax havens will have very less rate of taxation. Otherwise, why will MNCs enter into tax havens? Right? That is the reason. If taxes are charged on the sale, then what is the profit of registering in Panama type island country? Because most of the sales will happen outside Panama. Arey Baba. Right? That is the reason under pillar 1 and pillar 2, what are we trying to do? Tell me, using pillar 1 and pillar 2, what are we trying to do? Using those, we are trying to ensure the base erosion and profit shifting will not happen. Because right now, BEPS is happening. They are generating revenue from one country, they are paying the taxes in another country on profit. Because revenue will have implication over profit. I hope you understand. Revenue will have implication over profit. So obviously, we want to ensure that base erosion profit shifting will not happen by implementing pillar 1 and pillar 2. Okay. GAR concept. Arey Baba. If you have not understood the example, leave it. Trust me. If you have not understood the example, leave it. Because there is no point in right breaking your head in learning calculations. No point. What is a GAR? There are companies which are entering into arrangement with each other. Objective is to avoid tax. Tell me at least now. Point number one. There are companies which are entering into arrangement with each other. Objective is to avoid taxes. Now, under GAR is nothing but a document. It is set of guidelines. Under GAR, the tax official says this arrangement that you have done, it is to avoid taxes. You are entering into this kind of arrangement to avoid taxes. So, I will not give you the tax benefit. You'll have to pay whatever is the normal rate of tax applicable. That is a concept of GAR. Okay, that should be more than sufficient. Okay, any other question? Any other question? Okay, any other question? SCZ will discuss the SCZ later. Don't worry. We'll discuss special economic zone in detail later. Don't worry about SCZ as of now. Remember only one point. That is 5-year tax exemption is provided. That's more than sufficient. Okay, let's take a break. We'll restart the discussion at 8:22. We'll restart the discussion at 8:22. Please join back at 8:22. Okay, welcome back. Am I audible to you? Am I audible to you? Please do let me know. Okay, now before I go forward, I was just looking at some of the comments that the students have given. Some of the comments. Some of you feel all these calculations are very difficult. I do understand. Okay, you are not at all okay with any kind of calculations in your UPSC preparation. And if that is a problem, solution is very easy. Do not by heart any calculation. Do not be concerned about any calculations in GS paper 3. Again, I'm talking about GS paper 3. Right? I'm not talking about anything else. If your option is mathematics, I cannot tell you, do not worry about calculation. If your objective is, sir, calculation, these are very difficult. Should we by heart? Should we remember all of these calculation? Very simple answer to you, no. Right? Do not worry about calculation. Understand the statements, go forward. That should be more than sufficient. Now, let me go forward. GST. And by the way, there were certain students who are asking, sir, you told about semiconductor article. Right? You told about semiconductor article. From where, which newspaper are you talking about it? It is Hindu newspaper. It is a Hindu newspaper, yesterday's edition. Yesterday, Sunday's edition, Hindu newspaper. Read any edition for that matter. But yesterday's Hindu newspaper, there's a very lengthy article on semiconductors in India. In fact, if you talk about semiconductors, even today's Hindu newspaper, there's an article on semiconductors in India. Please read that. Please read that semiconductor article. Even today in Hindu newspaper, there is a statement given by Mr. Jaishankar. All of you heard of Mr. Jaishankar's name? Right? So please read that article. In addition to that, there is one more article about digital payments in India. Digital payments in India, central page article in Hindu Today. Please read that. Nice article. Important information is given. In addition to that, there is one more article on Udan scheme. Udan scheme. Yesterday also, today also, Hindu newspaper. Right, both the article in both the newspapers, yesterday's and today's, it is there on Udan scheme. Read about it. In addition to this, there is an article on prices of petrol. There's a statement given by the Congress party. Don't worry about the political angle to that, but think of what they are actually arguing. We have discussed this. The prices of international crude oil prices in the market have gone down, but the market prices in India have not been changed. That is the essence of the article. Read that. Right? Don't worry about political angle given to it, but read the concept behind it. Okay, so these are some of the articles. Go through that. Now, let me start. Goods and services tax. GST. Right? A goods and services tax. Now, very, very important to understand GST. Right? Focus now. Focus, follow the discussion. You'll have to understand two very important concepts to understand GST. First one is there is a term called as cascading effect. There is something called as cascading effect. We'll explain it, don't worry. And second one is a concept of input tax credit. One is a cascading effect. Second one is called as input tax credit. Understand both the concepts. These are centrally attached to the concept of GST. We'll use them. First one is cascading effect. A cascading effect is nothing but whenever a tax is imposed on existing tax. I'll repeat. Whenever a tax is imposed on an existing tax, this is called as cascading. Now, how there is a cascading effect and what is the problem with that? Let's start. Earlier, please understand this. Earlier, whenever the production of goods and services was done, earlier, production of goods and services, when it was done, the central government used to impose a tax by the name of excise taxes, excise duty or excise tax. And whenever the sales of this good is done, the state governments would impose a tax by the name of sales tax. Central government would impose excise, state governments would impose a sales tax. There is a problem related to these taxes. Why? Understand the example here. A will manufacture a product, sell it to B, and let's say the price is 100 rupees. A will manufacture a product, sell it to B, let's say price is 100 rupees. And right, let's assume the tax rate is 10%. So obviously, B will purchase the product by paying 110 rupees. Any problem with step 1? This is a step 1. Step 1 and a step 2. Okay. In the step 1, A will sell the product to B. B will pay 110 rupees, including a profit of 10 rupees. I'm sorry, including a tax of 10 rupees. Now, what B will do? B will use the product. It could be a raw material, it could be an intermediary good, anything. B will use it and right, let's say manufacture something else and sell it in the market. So now B has paid 110 for this, let's say intermediary good. B also wants to earn a profit of 20 rupees on this. So obviously B would want to sell the product to C at 130 rupees. B purchased it at 110. Now they want to earn profit of 20. They want to sell it at 130 rupees. Now government will impose a tax of 10% on 130 rupees. 10% tax on 130. It will become 130 plus 13 rupees. Right? The consumer in the market, customer in the market will pay how much? 143 rupees. Now please tell me, in the step 2, when you calculate a 10% on 130 rupees, are we calculating tax on a tax here? Please observe and tell me now. In step 2, when we are calculating 10% of 130 rupees, are we imposing a tax on existing tax? Anybody has a problem here? Answer is yes, by the way. Answer is yes. We are imposing tax on a tax. Any problem here? This is called as a cascading effect. Right? The previous step, there's a tax of 10 rupee out of 130 rupee. If I want to break it up, basic idea. Right? If I want to have a breakup of 130, right? Have a look at this. 100 rupee cost of raw material, 10 rupee, that is the tax that you have paid. Let's assume you are B, right? That is, you have paid the tax here, plus 20 rupee profit you want to earn. This is how, right? Basically, you have arrived at 130 rupees. Now, if I impose a 10% tax on 130 rupees, is it not as good as saying I'm imposing 10% tax on 10 rupee tax? Is the logic okay? Is it not as good as saying, right, imposing 10% tax on 10 rupee tax, which is nothing but tax on tax? This is called as cascading effect. Any problem? Can I go forward here? How it is 143? My dear, 130 plus 10% of 130. Please do the calculation. Let me know. 130 plus 10% of 130. Right? What is the problem? 130 plus 13 rupees. 143. Right? So 143 will be paid by the consumer in the market. This is called as cascading effect. Can we go forward? Right? There are two students who are saying voice is not audible or video has stuck up. Please hit the refresh button. Please hit the refresh button. Don't tell me it is stuck up. Please hit the refresh button. Right? Automatically it will start. Okay. Now this is basically cascading effect. Now please tell me question number 1. In cascading effect, the tax burden on the customer will be high or low? Let me know. Right? In the cascading effect, right? When there's a cascading effect here, will the tax burden on the customer, will it be high or low? It will be very, very high. Because ultimately, please understand, ultimately, whatever indirect taxes are paid by the manufacturers or by the sellers, who will bear the burden? Ultimately, who has to pay all these indirect taxes? Right? The customer has to pay all these indirect taxes. So the tax burden will be very high. Tax burden will be put on the customer. What about the market price of the product? Market price of the product will also be very high. Right? As a result of this, what if these are exports? What if this product that I'm giving you as an example here, what if this is an export? Don't you think higher market price because of cascading effect will reduce the effectiveness of the exports? Exports will become very costly. Right? These are some of the concerns regarding cascading effect. Now, look at the next system here. In order to address this issue, we introduce a concept of input tax credit. I repeat, in order to address the issue of cascading effect, we introduce the concept of input tax credit. Please look at the statement of input tax credit first here. Please look at the statement of input tax credit. What is input tax credit? Claiming the taxes paid on the inputs as credit from the taxes collected when the goods or services are sold. Claiming whatever taxes you pay on the input as a credit. Credit means getting the money back when you basically sell the product and collect taxes. Let me show it to you. Let me show it to you. Right? Same example. Let me show how input tax credit will actually work. Follow this very carefully. A will produce a good, sell it to B. Okay, A will produce a good, sell it to B. Now let's assume tax rate is 10%. Tax rate is 10%. So obviously B will purchase the product at 100 rupee cost plus a 10 rupee tax. 10 rupee tax. Now any problem here if I say B has paid 10 rupee tax on the inputs? Let me know. Anybody here who says, sir, this is not correct. If I say B has paid 10 rupee tax on the input, anybody has a problem with this? Now come to the step 2. Come to the step 2. If you go to step 2, right, understand the calculation now. In case of step 2, I have purchased raw material or let's say intermediary good at 100 rupee. Now I want to earn a profit of 20 rupee. But some of you will tell me, sir, what about the 10 rupee tax that you already have paid? B has paid a tax of 10 rupee. So B has to get this a 10 rupee tax. Government says, whatever tax you pay on the input, I repeat, whatever tax you pay on the input, that will be given to you, that will be credited to you. But when it will happen? It will happen when you produce this good, sell it in the market, collect the taxes from the customer and give it to government. Any problem with this? I'll repeat it again. What is input tax credit? You have paid a tax of 10 rupee when you purchased input. Now you will use the input, produce a good, sell it to the customer, collect a tax from the customer, give it to government. Now whatever taxes you paid on the input, government will credit it back. Government will transfer it back to you. Now, right, have a look at this. If 10 rupee tax that you paid earlier, if you get it back, if you're going to get it back, will you count the 10 rupee tax in the selling price when you sell the product to Susi? Think of it. I'll repeat the statement again. Government says you collect a certain amount of tax from the customer and give it to me. And this 10 rupee tax, I will give it back to you. So if that is the situation, will you count the 10 rupee tax when you decide the selling price of the product? When you're selling it to customer, you will not include it. All of you agree? You should not include it because you're getting it back from the government. So have a look at this. In step 2, cost of the product that you have purchased, input is 100. 20 rupee is your profit. You will simply assume, right? You will simply come to a selling price of 120 rupees. Now, government will impose a tax of 10% on 120 rupees. 120 plus 12, 130 rupees will be the selling price to the customer. 120 plus 12, that is 10% of 120 will be the selling price. 132 rupees will be the selling price to the customer. So what has happened in the system? Please understand now what has happened in the system. Question number 1. Please tell me, is there a cascading effect in this example? Please look at the calculations. Please look at the calculations. Is there cascading effect in the system? Is there cascading effect? No. Some of you are saying yes, there is a cascading effect. In which step? Those are saying there is a cascading effect. I've written step 1 and step 2. Please tell me, where can you see cascading effect? Those are answering yes, please tell me. Sir, in both the steps, cascading effect is there. In step 1, where is the cascading effect? This is very interesting. Right? There are two students who are saying in both the steps, there's a cascading effect. Please tell me, step 1, where is cascading effect? Hey, Baba, tell me. I am not finding any cascading effect in the step 1. Where are you finding cascading effect? I don't know. What calculations you are looking at, I absolutely have no clue here. Right? Why? Step 1, selling price is 100. Government imposes a tax of 10%. Where is the tax on tax in step 1? Where is the tax on tax in the step 1? Is there tax on tax in the step 1? Where is it? You show it to me. There is absolutely no tax on tax here. Come to the step 2. You purchase the product at 100. You purchase the product at 100 rupee. You want to earn a profit of 20. On this amount, government will impose a 10%. Where is the tax here? 100 rupees the cost of the product, 20 rupees the profit. Where is the tax here? On this, if I impose a 10%, where is the tax on tax? So tell me, right? I do not understand your argument. I absolutely have no clue as to what you're looking at. On 100 rupee, you're imposing 10%. 100 rupees tax. 100 rupees cost of the raw material. 20 rupee is your profit. On that, you're imposing 10% tax. So where is the double taxation? Where is the tax on tax here? Sir, if there is no tax in step 1, Hare Baba, step 1 is one tax. Right? Again, please understand the logic. Some of you are not even following what I'm saying. Cascading effect means what? Tax on a tax. Can you understand at least this? Cascading effect means tax on tax. Now, please look at step 1 and step 2 and tell me in any of the two steps, there is a tax imposed on a tax. Think, no, at least think, right, rationally. Is there any tax on tax in any of the two steps? Sir, on 100 rupee, you are imposing tax 2 times. Is 100 rupee tax? Let me know. Right? There are two students who are saying, but on 100 rupee, you are imposing tax 2 times. Is 100 rupee the price of the product or is it a tax? Think rationally, my dear. You don't listen only. Problem is that you do not listen to whatever I say. I've written clearly here, cascading effect means tax on tax. But you're saying, so 100 rupee you're imposing tax 2 times. Is 100 rupee tax here? What is your argument? Simply don't waste time. Don't complicate the issue. So under this system, there is no cascading effect. There is no cascading effect. And those who are saying, sir, the calculations are difficult, leave it. Don't waste your time. Don't waste the time of others also. Calculations are never asked by UPSC. Now, what is the concept you need to carry forward? There is an idea of an input tax credit. What is the meaning of input tax credit? Whatever taxes you pay on the inputs, will be credited back to you when you sell the product, collect the taxes and give it to government. Now, please tell me, in case of the seller B here, in case of company B or seller B, is a seller B getting input tax credit here? Let me know. Is a seller B getting the input tax credit here? That is basically the concept. Seller B has paid a 10 rupee tax, is getting the 10 rupee tax when he will collect the taxes from the customer, give it to the government. That is input tax credit. Understand this? Go forward. Don't waste your time. Some of you are, this is, I've taught the concept of GST from 2016 now. I've been teaching GST as a concept from 2016 because that is when it was introduced. I've never come across a batch of students who keep on asking, sir, how this price has become 132? when the calculation is there right in front of you, right in front of you. This is actually confusing to me now, right? The CSAT is so weak for some of the students. This is not a criticism, by the way. Do not take it as a criticism. I'm concerned about you, my dear. I'm saying the price is 120. On this, 10% is imposed in the form of tax. And your question is how it will become 132 rupees. Think of it. Please think of it. And looking at the CSAT paper, my dear, I'm very much concerned about you now. Right? Price is 120. On this, a 10% is a tax. You are asking me how this will become 132 rupees. My dear, use calculator. Use calculator. But think of CSAT paper as well. Now, is the logic okay? Now, this concept was introduced under VAT system. Okay? This concept of input tax credit was introduced under the VAT system. What is this? Right? What is this VAT system? VAT is basically called as value added taxation. Right? VAT is basically referred to as value added taxation. And earlier I hope remember this. I said central government will impose excise tax on production. Central government will impose excise tax on production. State government will impose sales tax on the sales of the product. So the state governments introduced a new system by the name of value added taxation. That is, they will replace the earlier sales tax regime and they would introduce the concept of value added taxation. And under value added taxation, what is the logic? At every step, we will provide you input to tax credit so that cascading effect will not take place. I'll repeat the statement. Right? At every step, we will provide you the input to tax credit so that right, there is no cascading effect in the system. So the idea of a VAT was introduced as a multi-point. Multi-point means what? Whenever the sales are going to happen, for example, is it multiple sales, right, or not? You please tell me. Here is a manufacturer. Manufacturer will sell the bottle to a distributor. Is it sales? Think of it. Is it a sale of final good? Now the distributor will sell it to another distributor, and this distributor will sell it to different shopkeepers. Different shopkeepers. Now all these are the sales, right? Whatever example I've given you right now, all of these are sales of final goods. So obviously the state government at every step, multi-point, at every step, the government would keep on imposing VAT and collecting VAT from the people. But argument was simple. Argument was very, very simple. If this first distributor has paid VAT already when they purchased from the manufacturer, when they will sell it to the second distributor, they would be provided with input tax credit. Simple. They would be provided with input tax credit. And when they are getting input tax credit, automatically cascading effect in the economy would be eliminated. This was basically the objective. This was basically the objective with which VAT was introduced. VAT, value added taxation, was introduced. But with introduction of the VAT, the whole issue of cascading effect was not eliminated. I'll repeat the statement. With introduction of the VAT, the whole issue of cascading effect was not eliminated. Even under the VAT system, cascading effect was present. How? Let me explain this. Follow this very carefully. Follow, follow, follow. If you do not listen to it very carefully, this will become very confusing. Now, whenever the goods will move from one state to another state, right? Whenever the goods will move from one state to another state, can I simply say this is interstate trade and commerce? Let me know. Whenever the goods will move from one state to another state, can I call this as interstate trade and commerce? And whenever there is interstate trade and commerce, central government, it is the central government which will impose the taxes. Remember this. as per the Constitution of India. Don't argue why not state 1, why not state 2. As per the Constitution of India, whenever it is interstate trade and commerce, the central government will impose the taxes. Now, earlier, central government had one tax by the name of central sales tax. Please look at it. Earlier, central government had one tax by the name of central sales tax. That is, a product is manufactured in one state and product will move across the border into another state and will be sold to the customer later. This is interstate trade and commerce. So central government had a tax by the name of central sales tax. Point number 1. Point number 2. Central government said whenever this product will move from the state 1 to the state 2, CST will be applicable, but this CST will be collected and used by the state where the production of the good has happened. I will repeat the statement. Understand, this is important. Under central sales tax, I'll start using short form CST. Whenever there is an interstate trade and commerce, CST will be imposed. But this CST will be collected and used by the state where the goods has been produced. Now, please look at the example. Please look at the example that I've given here. This bottle is produced in state 1. It will move across the border and it is consumed in the second state. Any problem with this? First statement, understand this very carefully. This bottle is produced in the state 1, moves across the border in the state 2 and is consumed in the second state. Now please tell me, CST will be collected and used by which state government here? Based on explanation that I've given, please tell me, CST, central sales tax, will be collected and used by which state? All of you will agree it has to be the state 1. Even after this, some of you are saying second state. This is very interesting. Very interesting. What was one of my statement? What was one of my statement? I said, central government will announce a CST. CST will be collected and used by the state where production has happened. And I said, this bottle will be produced in the state 1, moved across the border to the state 2, and consumption will happen in state 2. And I asked you, in this case, which state will get the CST? Some of you are saying state 2. My dear, is the production of bottle happening in the state 2? Where is your attention? Where is your attention? What are you listening to? Right? Please listen carefully. All of you, at least now, all of you will agree it has to be the state 1 which will collect central sales tax. Now come to the next point. Come to the next important point. Okay? Imagine you are a seller, right? You are using this product and you are selling it to somebody else in the market, right? You are right B here. You're B. Now think of this very carefully. You will purchase it at 100 rupee plus a 10 rupee. You have paid a central sales tax of 10 rupee. Now this CST has gone to state government 1. Are you registered in the state government 1? Look at the picture and answer. Are you registered as a manufacturer in the state government 1? Or are you registered as a seller in the state government 1? Please be very careful. Look at the picture at least. You are there in the state 2. That is the reason very nicely, again some of you are saying yes. That is the reason very nicely I've used red marker to say you are present in the second state. My dear, no, you are registered in the second state. You are a seller in the second state. Under VAT of the second state, you are registered. So you are not registered with the state 1, you are registered with state 2. Now this is very important. If you are registered with the second state, do you think state 1 will give you input tax credit? Simple question now. You are registered with another government. You are there as a seller with a second government. Do you think the first government will give you input tax credit with whom you are not even registered? No. State government one will not give you input tax credit. Second, will the state government two give you input tax credit? Think logically. Does it make sense to you? Does the state government too give you input tax credit? Have they collected tax first? Has the state government too collected any tax from you? No, they have not collected. But now you are asking for 10 rupee input tax credit. Will they give it to you? They will also say, sorry, I have not collected 10 rupees, so I will not give it to you. So state one, which has got the CST, they will not give it to you because you are not registered in the state one. State 2, you have not paid the tax on the input to the state 2, they will not give you input tax credit. Now, if both of the states are not going to give you ITC, where will you collect this tax from? From whom you will collect the tax now? You will collect it from the customer. Very simple. Center, arey nahi baba. Some of us saying, sir, we'll collect it from the central government. My dear, why will the central government give you a tax? Have they collected the tax here in the first place? Right? Has the central government collected the tax here in the first place? Please understand. If you want to get ITC, right, let me know. Simple question to you people. If you want to get ITC, don't you think in the first place the government should have collected tax from you? Yes or no? If you want to get the input tax credit, don't you think important condition is that government should be collecting tax from you? Only then they will give you ITC. Without paying input taxes, how can you get ITC then? You told interstate trade and commerce center is collecting. My dear, you will get the recording of this video. Do me a favor. There are two students who are telling me, sir, you said center will collect a CST. The recording of the video is available. Please play back. Not now. Don't start doing now. After the class is over. Show me the point of time. Show me the time where I've told CST is collected by the center. I clearly have told you. And if other students don't agree with me, please do let me know. I'm willing to correct my mistake. I clearly have told you in interstate trade and commerce, central government will announce a CST, but the state where production happens will collect and use the CST. Yes or no? Did I say this? Right? The central government will announce a CST, but the state where production happens will collect and use the CST. I've clearly told you. And after that only I gave you example of this bottle. I told production happens in state 1. So state 1 will collect the CST. So now have a look at this. B will not get ITC from state 1 nor from the state 2. What will B do now? B will simply transfer the tax to the customer. That is, right, the calculation will be done like this. 100 rupee cost of the product plus 10 rupee central sales tax, because nobody is giving ITC to the B here, plus a 20 rupee profit. So selling price will be 130 plus 10%, right? VAT imposed by the state too. 10% VAT imposed by the state too, because you are selling the product. So ultimately the customer will pay how much here? Customer will pay 143 rupees. Now simple question to all of you. Observe the picture and tell me, is there cascading effect despite having VAT system here? Let me know. Right? Is there a cascading effect here despite having a VAT system? Answer is yes. Right? That is the reason I said we introduced VAT system. And with the introduction of VAT system, we expected that cascading effect will be eliminated. But even after that, even after introduction of the VAT, there was a cascading effect in the system. And that is the reason we have introduced a much better taxation system now, goods and services tax. I'll go to GST, but before I go forward, this is an important point. Just make a note of this. If a good is produced in state 1, consumed in the state 2, okay, produced, consumed. If good is produced in the state 1, consumed in another state. If the tax will go to the state where production has happened, I repeat, good is produced in one state or and consumed in either the same state or another state, doesn't matter. But if the tax will go to the state government where production has happened, this is called as origin based taxation. Right? This is referred to as origin based taxation. Now, please correct me if I'm wrong. Can I say central sales tax is origin based taxation? Let me know. Can I say central sales tax is origin based taxation? On the other side, imagine good is produced in the state 1, consumed in the state 2. If the state 2 will get the tax, that is called as consumption based taxation. Consumption they will use, or else they will also use the term destination based taxation. That is, right, basically goods and services tax. GST, goods and services tax. Any problem here? Any problem in understanding this? Right? Whenever the good is produced in one state, consumed in another state, but the production has happened in the state, that state will get tax, that is origin based. And whichever state consumption of the good has happened, right, if that state will get the tax, that is called as a destination based tax. Okay, done. Let me go forward. Right? And it is not heading interstate sales. It is GST, goods and services tax. GST. Now, why the GST was introduced in India? Why GST was introduced in India? Point number 1, to eliminate cascading effect. And trust me, right, when we discuss GST in detail, you will understand how GST will eliminate cascading effect. I'll give you calculations. Do not by heart them, not necessary. But right now, understand GST will eliminate cascading effect. Point number 2, there were multiple indirect taxes. Now, under GST, either you can say taxes and cesses and right this. So, under GST, what we have done is, from the central government, we have taken lot of these indirect taxes. From the state government, we have taken lot of these indirect taxes. Only one tax across India now. Only one tax across India, goods and services tax. Right? That is the point number 2. Point number 3, it will help us in widening the tax base. More and more goods and services will be brought under GST. More and more taxpayers, such as companies, will be brought under GST. Now, with that, can I simply say that it will lead to widening of the tax base? Let me know. If more taxpayers are brought, if more and more goods and services are brought under GST, is it not going to lead to widening of the tax base? Any problem with this statement? Will it not widen the tax base? Arey Baba, how? How it will widen tax base? This is very, very bad. Very bad. Do you remember the term tax base? How many times do you want me to repeat it again and again? Do you remember the term tax base? What is a tax base? Tax base is basically any object on which we are going to impose taxes. Now I'm saying under GST, more and more goods and services will be brought. More taxpayers will be brought under GST. With more number of taxpayers, with more goods and services under GST, it will not widen the tax base. Why do you say it will not increase? You tell me. Because it will increase. It should increase. It's logically correct. I do not understand how do you think, but it is logically correct. What is your thinking? You tell me. Okay. Fourth point, the cost of transportation will also come down under GST. Cost of transportation will also come down under GST. How? Right? Understand the logic here. Let me show you a table. As per the government data, as per Government of India's data, whenever the goods are moved in India, whenever the goods are transported, 25% of the time, 25% of the time taken for transportation is spent at the check post. All of you seen a check post? For example, imagine this is right a state 1 and this is a state 2. You have manufactured a product in state 1, you want to move it across the border into the second state. Earlier, what used to happen is at the state border, there will be check post. There will be a check post. A check post means a place where checking is done. That's it. Check post. So when you are supposed to take the goods, enter into the second state, you will stop at this point, take your documents. There will be officials, government officials who are sitting there. Show the documents to the government officials, pay whatever charges they will impose, and go into the next state. Enter into the next state. Now, the check post at this point of time before GST, the time taken at the check post was approximately one fourth of the total time taken for transportation. Right? Approximately around one fourth of the total time taken for transportation. Imagine that, one fourth of the time. Meaning, imagine you are moving a product from this state to this state. If you require 24 hours to transport it, 6 hours. For 6 hours, the truck was simply standing at the check post only. This was the amount of time. Don't you think that's a very lengthy time? Think of it. Right? Don't you think that's a very, very high time, right, that is consumed at the check post to transport goods in India? And what is the problem with this timing? Whenever you're taking more and more time at the check post, please tell me what will happen to the cost of transportation. Think of this. When you're taking more and more time in the check post, let me know what will happen to the cost of transportation. Don't you think cost of transportation will start increasing? And when the cost of transportation increases, what will happen to the market price of the product? Market price will also start increasing. Input cost prices will increase, etc. etc. So Government of India says under GST now, understand, under GST, we will not be having any check post in the interstate borders. Under GST, right, there will be no check post in the interstate borders. If you want to move the good from one state to another state, there will be no check post. Easily you can travel from one state to another state now. Now tell me, if this kind of a system is there under GST, don't you think GST will help us in reducing cost of transportation? Let me know. It will help us in reducing cost of transportation. And if cost of transportation reduces, can I also say GST will help us in reducing cost of logistics? Any problem with this? GST will also help us in reducing the cost of logistics. Right? That is the reason, right? The transportation costs were very higher. Now with the GST, we want to reduce it. And the GST will help us in promoting ease of doing business. GST will help us in promoting the ease of doing business. Right? Earlier also I've discussed this point. Don't say, sir, what is ease of doing business? Simply don't keep on asking the same thing again and again. Earlier also we have discussed how GST will help us in promoting the idea of a ease of doing business. Multiple taxation. Arey Baba, I don't understand. Why do people do not remember what we are discussing? Let me know. Let me know. Did we discuss this earlier? Multiple taxes to a single tax. Did we discuss this earlier? How much time? Hardly 1.5 hours. Earlier, what used to happen? There are multiple indirect taxes at the central level, at the state level. I said under GST, we have brought all these indirect taxes under GST. Only one tax now. The same point. I'm actually surprised by some of your questions today. I'm actually surprised. Why? I'll tell you. Right? You people are behaving as if I'm using these terms for the first time ever in the classroom. That is your behavior, which is actually surprising to me. Right? Because it's nothing new. We are discussing same thing, running around the same bush again and again. Fourth point, cost of transportation. I'll repeat it. Because you're spending a lot of time at the check post, cost of transportation will go up. Right? Because of a higher cost of transportation, the market prices will also be influenced. Now under GST, right? Basically, what will happen is the check post will be removed, and as a result of this, right, basically the transportation will become easier, time taken will go down, and right, basically that will help us right in reducing the cost of transportation. There is one more student who says a GST not widening tax base. My dear, do me a favor, please go to Google and type GST plus higher number of registrations. Do me a favor, higher number of registrations, and please tell me what the Google will tell you. Right, will the Google will tell you that, and this is what Google will tell you, compared to earlier taxation system, now number of people, or let's say number of businesses which are registered to pay GST have increased. Compared to earlier taxation system, under GST, number of taxpayers have increased. Can I give you a current affairs example? Can I give you a current affairs example? Have you been reading about the 28% GST that has been announced by government very recently? Don't you think 28% GST announced by the government on some of these taxpayers, earlier it was not there on them? A simple idea, Baba. How difficult is it? Earlier it was not applicable on these types of taxpayers. Now government says you will be under GST. You will have to pay 28% GST. Will it not increase, widen the tax base? What is your argument? You please tell me. What is your counter argument to this? Because the fact is simple. Economic survey says number of taxpayers under GST have increased. They've actually increased. Okay. Now, what are the important features regarding GST? What are important features regarding GST? One, it will streamline or subsume all indirect taxes. Right? All indirect taxes. In fact, to be very specific here, many cesses will also be subsumed, have been subsumed under GST. Many of these cesses which are applicable in addition to indirect taxes, they also have been subsumed under the GST itself. I'll give you a list. Please have a look at it. Now don't start doing PhD on all these taxes. Right? Because the logic is simple. As of now, under GST, around 40 types of indirect taxes plus cesses have been subsumed. I'll repeat the statement. Under GST, around 40 types of the indirect taxes plus cesses, all of them have been subsumed. Subsumed means they are included in GST. Instead of those, there is only one GST applicable now. That is subsuming. Do you want to do PhD on all these 40 types of indirect taxes? Not needed. Why? These are not present in India today. Only GST is applicable. So read GST. Don't basically complicate by reading every taxes that you'll come across. These are some of the taxes at the central level which have been brought under GST. These are some of the taxes at the state level which have been brought under the concept of goods and services tax. Okay. Now, first important feature is it will streamline, it will subsume all these indirect taxes, and as a result of this, we want to achieve one nation, one indirect tax. We want to achieve one nation, one indirect tax. Point number one. Point number two, have a look at this. If you want to have all these indirect taxes from the central government, from the state government under the GST, can I say, first you will have to amend the Constitution of India. First you will have to change a provision in the Constitution of India. All of you will agree with me now? Sir, why? If you ask me why, these taxes under the Constitution are given to the states, are given to the center. But what are you doing now? You are taking from the state these taxes and from the central government. So without changing, without making a change in the provision of the Constitution, how can you do that? So that is the reason 122nd Constitutional Amendment Bill. 122nd Constitutional Amendment Bill was introduced. 101st Constitutional Amendment Act was implemented. Now, those of you who are not over with, or who have not completed polity, do not worry about constitutional amendment. Right? When you read in polity, you'll come across concept, process, what is required, right? In which case you need majority, in which case you require even the state governments, etc. In polity, we'll learn what is amendment, why do we need to do that, what is the process of that, etc., etc. Right? You will learn it in polity. Please do not be worried about it. So we amended the constitution, right? And as a result of this, we have been able to implement GST. Now, next point, we also introduced, right, one article in the Constitution of India, Article 279A. And as a result of this new article, we have established a new constitutional authority, right? We have introduced a new constitutional authority, that is GST Council. Important, please remember this. Right? GST Council is a constitutional body. It is established by the President of India. GST Council, the composition is very simple. There will be Union Finance Minister and there will be other people from central government. Plus, there will also be state finance ministers. From the states, it will be the finance ministers of respective state government, and from the central government, it will be the Union Finance Minister. And please understand, even those union territories which will have legislative body, I repeat, even those union territories which have legislative body will also be represented in the GST Council. Right? So the Union Finance Minister will be the chairperson. The chairperson is the Union Finance Minister. And what are the functions of the GST Council? GST Council will decide what should be the model of GST for India, what goods and services should be brought under the GST, what should be the rate of GST applicable, what goods and services, right, the GST rate should be reduced, for what, right, it should be increased, etc., etc. Let me connect it to current affairs. The 28% GST rate which is applicable for online gaming now, can I simply say that it was decided very recently by GST Council? Correct or wrong? 50th GST Council, by the way, 50th GST Council meeting. GST Council decided that we should have 28% GST rate applicable on online games. Right? So I hope you understand. Connected to current affairs, automatically you will get all of this. Now, apart from this, the quorum requirement is at 50% of total members. What do you mean by quorum? Right? For those of you, polity is over. Morning session. What is quorum? Quorum means what should be the minimum strength? What should be minimum number of people who are present so that we can start with the work? Quorum requirement is 50% in the GST Council. In GST Council, it is 50%. Right? Now, whenever you talk about decision, right, whenever you talk about decision making process in the GST Council, please understand, one third of the voting rights have been given to the central government, and remaining two-thirds has been equally divided. I repeat, right, remaining two-thirds was equally divided with all the states or between all the states. Any problem with this? Whenever you want to make a decision in the GST Council, you need to vote. Central government should vote, states should also vote. But how much is the voting right given to all of them? Two-thirds of the total, 67%. Two-thirds is nothing but 67%. So 67%, I'm rounding off the number, by the way, 67% will be equally divided between all the states, including union territories with legislative bodies. And remaining one third, that is 33%, will be given to the central government. And whenever you want to have a majority, sorry, understand this, whenever you want to have a majority, that is a decision making in the GST Council, you need a majority of at least 75% of the votes. Whenever you want to have, right, whenever you want to have a decision in the GST Council, you should get at least 75% of the votes. 75% of the votes. Now, please tell me, based on this, can I say central government will decide everything in the GST Council? Decide in the sense, central government will have the final say. Again, please be very careful. Do not twist my words here. Central government will have the final say, veto power. Think of it, my dear. Can I say central government will end up having veto power in the GST council? Some of you are saying no. My dear, please understand this. Imagine all the states are in favor of one thing. Let's say all the states want the GST rate on the bottle to be reduced from 28% to 18%. I'll give you a simple example, by the way. Okay. All the states will, right, want to reduce the GST rate on this. Central government says no. Central government says no. I will vote against this. Please tell me, can you get 75% votes in the GST council? Apply CSAT numbers now. Apply CSAT numbers. Can you get 75% in the GST council? Absolutely no. You will not be able to get 75%. Why? If you put all the states together, how much can you get? Two-thirds, that is a 67%, right? But you require 75%. You require 75%, 75% of present and voting. So if the central government says no, I will vote against it, done. Done and dusted. You will not be able to get 75%. Right? And now can I simply say, right, because of this, central government has a kind of a veto power in the GST council. Right? That's argument. Okay? Any difficulty here? Any difficulty in the features? Please do let me know. Can we go forward? States can stop a center from imposing GST. No, that generally doesn't happen. It has to come from GST council. It has to come from GST council. GST council takes a decision. Any problem? Can we go forward? If nobody is going to ask a question, I'll assume you have understood. I will go to the next point. Each state two-third votes. Who said each state will get two-third votes? Where did I say that? I said 67%, two-thirds of the votes will be equally divided amongst all the states. That is what I've said. Right? You are not listening to what I'm saying. That's a problem. You're not listening to what I'm saying. Don't worry about petrol and diesel. I'll explain that in some time. Don't worry. Okay. Quorum means what is the minimum present? How many members should be present in order to start the discussion? Right? Can finance minister alone come, sit and take a decision then? No. Right? Minimum representation, minimum people, 50% of the total strength must be present in order to start the discussion. Okay. Now, what are the other features? In India, we follow a concept of dual GST. Right? We follow a concept of dual GST. Right? Now, what is this idea of a dual GST? Let me explain. GST rates. Have a look at this. I've written that slab here. Slab means nothing but rate. What are the GST rates mainly applicable in India? We have 0%, we have 5%, we have 12%, we have 18%, we have 28%. Any problem with this? The most important, most of the goods and services are covered either under 0, 5, 12, 18 and 28%. Now pick up any one of the rates. Pick up any one of the rates. Let's say 18%. 18% is divided into two equal parts. I repeat, 18% is divided into two equal parts. 9%. 9% and 9%. This 9% will go to the central government. Is it okay? Don't ask which of the two 9%. Both are equal, 9% only. So one of these, that is 9%, will go to the central government. Hence, we'll call this as central GST, that is CGST. Any problem here? Hence, we'll call this as a central GST, that is right, CGST. The other 9% will go to the state where consumption of the product will happen. I'll repeat the statement. The other 9% will go to the state where consumption will happen. That is state GST, in short, ESGST. Any problem with this? Because there are two components. Dual means two. Because there are two components in the GST, this is called as a dual GST structure. Right? We have basically adopted this model of a dual GST structure from Canada. Canada also uses a dual GST model. Okay, so dual GST. Now, what is the meaning of integrated GST? Please understand. Integrated GST basically is applicable whenever there is a interstate trade and commerce. Simple, right? A GST that is levied on interstate trade and commerce. Integrated GST or IGST is applicable. But please understand the logic. Some of you will ask, sir, when there is GST, why do we have IGST? Reason is simple. Please tell me, if this product is manufactured and consumed in the same state, don't you think GST distribution in this example will be different compared to another example where production will happen in one state, consumption will happen in another state? Let me know. Let me know. Very simple question to you people. Example 1, bottle will be produced in state 1, consumed in state 1. Example 2, bottle is produced in the state 1, consumed in the second state. Don't you think how GST is distributed, who will get a GST will be different in both the examples? Is the logic okay with all of you? Is the logic okay? That is the precise reason. Whenever there is interstate trade and commerce, right, we will simply impose IGST, integrated GST. Rate does not change. Rate does not change. Only, right, which state government will get SGST, that will change. Okay. Next one. There are certain goods which are exempted, right? Which are exempted. Exempted in the sense, right now, GST is not applicable to them. GST is not even applicable to them. What are these goods? Best example for this is alcoholic consumption, alcoholic production for right human consumption. For example, right, read Delhi case. Even if you have not read, please tell me, based on this itself, you should be able to answer this. Who imposes the tax on alcohol that is produced in India? Let me know. Who will get, right, who will get the tax, impose and get the tax which is produced in India? It has to be the state government. It has to, Are Baba, some of you are saying central government. Have you heard about Delhi liquor case? Delhi liquor case. Have you heard of this or not? Right? If you have heard of it, what is the argument there? The government of Delhi imposed the taxes and collected taxes. Simple argument. Simple argument, my dear. Certain goods are exempted. These are not under GST. Now, GST Council to decide when to impose taxes on crude petroleum, high-speed diesel, natural gas, aviation turbine fuel, etc. That is, in simple terms, right now, fuel products. Right now, fuel products, right? Basically, we are keeping them under GST. They are part of the GST. But GST Council has not yet announced what is the GST on all of them. I'll repeat the statement. Right now, right, on all of them, these are covered under GST. Right? That is, the fuel products are covered under GST. But please understand, the GST Council has not yet announced GST rate on fuel products. Right? That is one more point. And finally, the concept of compensation. Finally, the concept of compensation. What is this idea for compensation? Let me give a very simple example. Let me give a very, very simple example here. Imagine you are the state government. Right now, understand this before GST. Imagine you're the state government. Right now, you have the power to impose VAT on this bottle and collect a tax. Very simple example. Okay, you are the state government. You have the right to impose VAT on this bottle and collect. Now, from 1 year to next year, can you change the VAT rates based on your requirement? Right? Can you keep on increasing VAT rate from 1 year to next year? Of course, yes, you are allowed to do that because you have that power, which means you alone can decide what is the tax rate. Based on your requirement, you will decide the tax rate. But now tell me, this bottle, the VAT rate on this bottle, now it is not there. this has been brought under goods and services tax. This is brought under GST. Will you not be concerned about how much revenue you will be collecting under GST now? Let me know. Are you not concerned how much revenue you will earn under GST? What if it happens? Understand the problem here. What if before GST was introduced, you are able to earn more revenue, but after GST, you are earning lesser amount of revenue? Right? Then you will oppose the GST. And can you alone decide what is the rate of GST on this bottle? You cannot decide alone. It has to be decided by GST Council. So the argument was very simple here. States were concerned that with introduction of the GST, they might end up losing revenues. They might end up losing revenue. So central government said, for 5 years, once I introduce a GST, for next 5 years after the introduction, I will give you 100% compensation. I will give you 100% compensation. Now, compensation is calculated. Follow this very carefully. Slightly technical. Follow this very carefully. I'll take the same bottle example. Imagine this. On this bottle, you earn 100 crore rupees. You earn 100 crore. Right? Before GST was implemented. Now, once the GST is implemented, Government of India says this number is fixed. That is next number. Government of India says from next year, once GST is introduced, from this year to next year, we will simply assume that your revenue will increase by 14%. The 14% is fixed. I repeat, right? Before introduction of GST, you earned 100 crore. And once the GST is implemented, I will give you the number 14% from 1 year to next year. From 1 year to the next year, right? I will assume that your revenue will increase by 14%, which means next year, how much revenue you should be getting under GST by selling this bottle? Under GST, how much revenue you should be collecting? 114 crore rupees. Array, some of you are saying 28 crore. 100 crore before GST. Increase it by 14%. 114 crore. Is the calculation okay with all of you? Let me know. Right? Is the calculation okay with all of you? So as per the formula, your expected revenue, the expected revenue collection is 114 crore. But what if you end up collecting only 80 crore rupees under GST? Your expected revenue is 114 crore, but what if you end up collecting only 80 crore rupees? This 34 crore rupee is called as revenue loss. Is it okay? This 34 crore rupee will be referred to as a revenue loss. And this 34 crore rupee, that is a revenue loss, 100% of it, 100% of it will be paid by central government. 100% of this 34 crore will be paid by central government. Any problem with this? So every year, from 1 year to next year under GST, we will simply say that your revenue will increase by 14%. But what if it doesn't increase by 14%? Then whatever is the revenue loss, revenue shortfall, 100% will be paid by the central government. Now, couple of more points are there regarding this. We will take it up tomorrow. Couple of more points are there, right? We'll take it up tomorrow. By the way, please tell me now, GST, has it been more than 5 years since the implementation of GST? Last point with all of you. Has it been more than 5 years since the implementation of GST? Yes. So tell me now, is GST compensation provided even today? Look at the slide and tell me, is the GST compensation paid even today? Answer is no, because 5-year duration is already over. Okay, so a couple of more points are there regarding this. We'll pick it up tomorrow. If you have any kind of questions, please do let me know, right, so that we can address. Otherwise, right, please, others can move, right? I'll not be discussing any concept anymore. Is it not wrong to implement 28% on game, which Modi ji some ago told as a skill growing sector? Okay, Again, whether this is wrong or not wrong, right? Arguments are there in both the sides. There are arguments in both the sides, right? You cannot simply say this is wrong, right? You cannot simply say this is not wrong. For sector, this is very difficult to sustain the business now. For this model, that online gaming model, it is very difficult to sustain the business now. But on the other side, government says I'll be able to collect a large amount of tax revenue now, right? So there are arguments in favor as well as against this decision of 28% taxation. Okay. Any other questions? Sir, if in case country to country transfer IGST is applicable or not, my dear, if you are exporting, let me ask you a very simple question. If you are exporting, please tell me, would you prefer imposing taxes on exports? Think of it. Please think of it. If you are exporting, would you want to impose the taxes on the exports? Those who are saying yes, if you impose a tax, don't you think your products prices will increase? Rather than exporting more, don't you think exports will fall down? So generally, taxes can be imposed on exports as well as imports. We do not target exports for imposing taxes. We rather target imports for imposing taxes. GST is applicable there. Okay. In case the state earns more than expected revenue, will the state get compensation? You tell me, does it make sense? Please tell me, does it make sense? You are expected to earn 114 crores. You end up earning 130 crore rupees. Will center give you compensation? No. GST is a kind of ad valorem. Yes, generally it is imposed on the value of the product. It is imposed on value of the product. Sir, you said within every tax slab, SGST and CGST will be equally divided, but as per Finance Commission, it is 4159. What is the difference? Arey Baba, you tell me what is 5159. What are you talking about? I don't know that 4159. Please tell me the context completely. Right? I have not come across this. IGST is applicable whenever the good will move from one state to another state. Interstate trade and commerce, IGST is applicable. Right? That is basically, let's say, 28%. IGST of 28%. 14% will go to the center, 14% will go to the state where product will be consumed. IGST. 41% to states from divisible pool. Arey Baba, you're talking about Finance Commission. I'm talking about GST. Both are different. Both are different. You're taking something and merging it into something which are completely two different things. Don't worry. After the 5 years, GST not collect compensation. Right? And now we are collecting compensation. That's the reason I said a couple of more points are there. I'll discuss tomorrow. Even today, center is collecting a GST compensation cess, but it is not giving it to states. Right now, states are not getting any compensation. Okay. Sir, argument for introducing GST was multiple tax, but even after GST, there are multiple slabs. I'll address that. If you look at it, next part of the discussion is precisely that only. Why did we introduce multiple tax rates under GST? I'll tell you tomorrow. Don't worry. Okay. Okay. Anything else? Which books to refer? Whatever book you have, please read that. That is more than sufficient. One static source is more than sufficient. Okay. On liquor and fuel, no GST is imposed. We'll tell you later. Don't worry. I told you, right? I will tell you about this later. Please do not worry. Income effect and substitution effect. Please understand, if your income changes, what is the impact of that on the consumption? That is income effect. Substitution effect, if the price changes, how will you keep on substituting the product with another product? That is called a substitution effect. Okay. Suggest a book for reference. Any book you want to use it, use it. But this is my concern. This is my concern. Any book that you are using or reading, right, they will not consist of all these points. I don't say this book is not giving this, etc. But these points are important. That's the reason I'm giving you in the classroom. Okay. Okay, done. So let me stop the discussion today here. Let me stop the discussion today. Let's continue, right? Let me continue tomorrow. with the concept of compensation itself. Certain more points are there in the compensation. We'll discuss that. Then we can go forward to other points under the GST. Okay. So take care. Right. See you tomorrow at the same time, morning 6 a.m. Okay. Have a great day.